people are really reacting to pieces of data that confirm the soft landing.
The market is broadening. It's moving into other more value-oriented parts of the market.
I mean, the big tech has clearly done a lot of impressive lifting here.
I do think the market's a few points overvalued.
I do think our prospects are good long run.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. TK taking a break today. Your equity market just a little softer, down 1/3 on the S&P 500. The headline of the past 24 hours, the bulls on Wall Street getting a whole lot more bullish. Let's start with Oppenheimer's John Stolfus, now looking for, on the S&P 500, 4,900 from 4,400. Credit to him, that 4,400 price target, Lisa, set at the end of December. So he was bullish and right to be bullish, and he raises his price target. Citi are now looking for 5,000 by the middle of next year. So it's record high watch on the street now.
It's record high watch, and the potential for, if you believe John Stolfus, a 28% gain for this year, which means that it would be the biggest gain going back to 2019. And here's the real issue. Can we get the start of a new bull market given some of the increase in credit contraction, some of the softening that we see in economic indicators? Could this still be the start of a new bull market, as many people are calling for?
I love what Citi's Scott Cronin had to say. He said, clearly we're chasing the tape, just acknowledging it straight off the bat. Went on to say this, though. Growing conviction in next year's earnings acceleration is a key point of differentiation. So he's looking for earnings to accelerate into 2024.
One of the key underpinnings for a lot of these bets, and I'm not speaking to Scott Cronin, but more broadly, is that eventually the softness will cause the Fed to pivot, which will sort of turbocharge the rally that we've already seen, including some of the earnings, because then all of a sudden borrowing costs will drop. This is the big bet that gets people to continue to buy into equities. And then you have all the people saying, isn't this what we've heard before? How do we get tightening credit standards to this degree without a recession, without something more substantial, a little more pain?
Capital economics were talking about that yesterday, given the degree of tightening we've seen in credit standards. We've seen it again. We saw it in the latest report just yesterday, Lisa. Demand for loans a little lighter. Credit standards tightening just a little bit more. But it's not what we expected coming out of the banking malaise of, say, 3 months ago. We thought it would be drastic, faster, harder, and it's been slow, and it's just continued at a steady pace.
I was thinking about this last night. Does it matter if it's slow and steady versus sudden and a break in credit creation? In the past, it hasn't mattered. Each of the 4 times since this index was created, every time of tightening in credit conditions like the one that we're seeing right now has led to a recession every single time. So is this time different? Can you put a bet, a strong bet on this time is different? A lot of people are saying yes. And that, I think, is interesting because everyone always used to say those are the most dangerous words in all of finance.
5 months of gains on the S&P 500. The gains continued through the month of July. Your equity market this morning, and good morning to you, just a little lighter, softer, negative down on the S&P 500 by, let's call it, 1/4%. Yields basically unchanged. Your 10-year 396. Going into a ton of data a little bit later. The dollar stronger. A break of 110 here on the euro. 109.76. On that currency pair, Lisa, negative here by 0.2%. And
we're going to be speaking with Jordan Rochester later on, who has an interesting call on the euro. Today, when you talk about the data, 10 a.m., U.S. JOLTS data come out. The job openings, which a lot of people say might not be all that reflective of just where we are with 2 job openings, or almost that, per each employed American, unemployed American. We're looking at the potential for a loosening market, which is what people want to see. We also get ISM manufacturing data, which I know you'll be looking at very closely, especially what we've seen in China and Europe, which is manufacturing recession ongoing. 10 a.m. also, Fed speak includes Chicago Fed President Austin Goolsbee. He sounded pretty close to declaring victory yesterday. He was speaking with Yahoo Finance, and he said that the soft landing is this golden path that would be a triumph and is certainly a possibility at this point, basically talking about possibly not raising rates.
Hasn't made his mind up about September.
Yeah.
Speaking of Yahoo, I thought that was maybe the headline for me, that someone as dovish as Austin Goolsbee hasn't made up his mind for September. Now, whether you believe him or not, I guess it's a separate thing.
That was where I was going to go.
Clearly, they want to make you believe that the September meeting is live and the data between now and then matters.
Well, I think that that's the point that really gets hammered home. I think a lot of people are leaning towards September a pause at this point. But the Fed doesn't want to say that because they don't want to give the all clear kind of signal. Today, when it comes to how long the consumer can keep spending, we're getting a number of earnings. Before market, Uber, Marriott, JetBlue, JetBlue and Norwegian Cruise Lines for all the cruisers out there. After the bell, we get Caesars Entertainment and Starbucks. We also get Pinterest and AMD. But the year-to-date gains have just been stunning. And yes, it's a recovery trade, but Uber shares basically doubling this year. Norwegian Cruise Line up 80%, Marriott up 36%. How long can people still do the YOLO? The, FOMO, YOLO, and post-pandemic revenge travel.
See how expensive Uber is in New York City now?
It has doubled, at least.
It's insane.
Yeah, and so you think about that. How long are people going to say okay to that and still order their salads and get it delivered by Uber?
I'm flagging yellow cabs now on a daily basis.
Really?
Seriously.
Really?
Seriously.
Okay.
You will see me in Midtown flagging a yellow cab.
But the quality is different because the whole ecosystem has changed. Have you noticed that?
What, you mean the yellow cabs are better?
No, I think that it's different because the Uber drivers are more distinguishing with respect to who they take or they don't because of the rating system, and the yellow cabs don't. So there's sort of a harsher tone, I feel like.
You mean the quality of the Uber is better?
Yeah, and just in general, the stories from the driver.
Okay.
It's a more hardened experience in the yellow cab.
You've got a good rating, right?
Yes, I do.
A 5.00?
Not anymore.
No, has it come down?
It did come down.
What's it come down to?
4.96.
Oh, same as me. There we go.
Okay.
There we go. That's good. Good benchmark.
I'm glad. I can't believe
One
I feel
day
so
I'll share
seen.
with you TK's
Oh, yeah. I don't even
Uber
want to know
rating,
that. Actually, I really do.
You can find out a lot about someone based on what their Uber rating is. We'll talk about that another time. Patrick Armstrong joins us now, CIO of Plurimi Wealth. Patrick, wonderful to catch up with you. We get these notes on a daily basis on our guests, and there was this line from you that just made me laugh. We continue to own tech and communication stocks, brackets, thank God. And Patrick, I think a lot of people might feel like that if they have been in tech so far year to date. There is this feeling more recently that it's time to shift, get away from the big winners. Patrick, what are your core holdings in technology in the United States still?
So I own Apple, I own Google, I own Adobe, Fortinet. So I've got a lot of them. Pretty much a market weight. None of them are cheap anymore. They're all expensive. I'm not planning to be selling them. Probably the biggest mistake I made over the last decade was selling these kind of stocks when they hit 30 times earnings in 2018 and 2019. They moved much higher after the sell-off then. So you can see a lot of scenarios where they stay at elevated multiples. These are companies with dominant market shares, producing above average growth. Definitely not cheap. Fresh money coming in today, I'd probably rather be selling puts on them, to be honest, rather than buying them outright. So just betting against a massive downside, and that would create a forced discipline of buying them on a sell-off. But those are the kind of stocks that are driving my portfolio this year. I've got a market weight, but they are expensive.
Well, they've done well, that's for sure. Double-digit gains almost across the board. Patrick, there is this talk, of course, and I mentioned it, about rotating away from some of those winners towards, say, energy and banks. Banks had a wonderful month through July. Patrick, what would fund that move into energy, which you're looking for outperformance from? I think we may have lost Patrick Armstrong there, unfortunately. So that's a good start to this morning. Patrick Armstrong of Plurimi Wealth. He's had a great year, hasn't he?
Yeah.
Think about some of those core tech holdings that we've had so far year to date from him. And also rotating out of some of the winners over in Europe, LVMH. I remember when he came on this program, I made that call. That's a decision we've all got to make, right? If you have been in tech, do you want to stay with tech? And to Patrick's point, I think there's so many people out there like him who have sold those names and then regretted it later, given the performance of the last 10 years.
There is a feeling, though, of arbitrariness to some of these calls, just because there is acknowledgement that everyone's riding momentum. I mean, I'm even looking at Patrick's comments in his own notes. We continue to own tech and communication stocks. Thank God, right? I mean, there is this feeling right now where it's almost up to luck or getting a sense of what the zeitgeist is, to use Tom's word, or to go with the flow and look for the tea leaves for when to get out. So these are some of the things that people are talking about at a time when the skeptics are getting smaller and quieter. But they're saying, really? Is this really going to sustain a rally that much?
You can't believe it's August already. Just to work through July and talk about some of the winners. I was going through the year-to-date gains and the monthly gains. Let's start with the monthly gains. 5th month of gains on the S&P 500. 3% gain in July. Longest monthly winning streak now on the S&P, going back to 2021. Had some slight outperformance on the NASDAQ. I know that changed towards the end of the month, but the NASDAQ outperformance on the month, the NASDAQ was up by close to 4%. But the standout winners, small caps, up 6%. Banks on the S&P 500 up by 10%. We have left March way behind and moved on pretty quickly, Lisa.
And the story that I think is the sleeper story that will come to the fore is oil. It has been a massive gain in oil. We've seen the biggest gain going back to January of last year in terms of a monthly basis. At what point does this start to bite a little bit more as people talk about the tightness in this market and the fact that it might have been distorted by people not wanting to own physical oil because it actually costs something, opportunity cost of not putting your money in a money market fund?
I'm pleased we've re-established the connection with Patrick Armstrong of Plurima Wealth, who joins us over the phone. Patrick, I wanted to squeeze in that extra question, and my apologies for the technical problems. You're funding that move towards energy. Can you just explain where that money's coming from? If you're not trimming tech, what are you trimming?
Well, I'm letting tech run, but I've actually been overweight oil all year, so it's not been a good call for me. But they are compelling valuations. There's been more oil consumed today than there ever has in the history of the world, and oil companies are down year to date. They're producing massive cash flow. They're buying back shares. They're paying dividends. They don't have the debt issues of the past. And with OPEC showing an inclination to cut on any weakness in oil prices, I do think we've got oil prices that are going to stay sticky at these levels with upside if we ever get to Asia and China really performing the way people were expecting earlier in the year.
Is it consistent to see oil prices continue to rise and the rally that we've seen more broadly continue, right? I mean, is there basically a reason behind some of the decline in oil prices that have fueled the soft landing story that has underpinned some of the gains in the other sectors of the equity market?
I think that's part of it. So you've probably had a little bit better margins across industrials, airlines, companies as oil prices did sell off. But I don't think oil prices at $80 a barrel are really going to change the profit outlook. If you did see a spike in oil based on some exogenous events, that would obviously impact margins in other sectors. But oil prices gradually moving higher, staying sticky at these levels, create great profits for oil companies. But I don't think it's going to create a significant headwind in margins in other sectors.
How long can you ride momentum, Patrick?
Yeah, so I'm thinking about it. I'm sticking with the momentum that I've got in the portfolio. But they're not at ridiculous valuations, the companies that I own, but they're not cheap anymore. I actually bought Adobe in March, and it was trading at 24 times earnings, which was a premium to the market, but now we're up in the high 40s times earnings. Apple was 20 times earnings in October. We're up to 30 times earnings. So if they do have another significant run-up that's driven on multiple expansion, I'm going to have to start to trim them on valuation measures. I won't cut them completely, but we are in the final innings of a multiple expansion rally in these stocks. You'll have to see real revenue growth rather than just prospects of growth for me to continue to own them.
Lisa alluded to it. It feels like we've been in that final innings for the last 5 months, something like that. Patrick, thanks for jumping on the phone and making this happen. Patrick Armstrong there of Plurima Wealth. You can just sort of copy and paste these worries, these comments about this market being too extended through the whole of the past, I would say 3-4 months. Even
with the argument that it's been all multiple expansion and not underlying revenue growth. I mean, that's the same argument people have been making for a while, and yet things have continued to melt up, which is the reason why a number of people have just come out and said, you know what? We're going to go with it, because why are you going to fight this? I mean, we heard this yesterday from Michael Purvis. Look at these charts; they look really good. The charts is how can you short this chart? You know, and then all the people are saying, well, you know, fundamentals at some point will matter, but not for a while. So make hay while the sun's shining.
I have great respect for the technicals and those kind of people who can just say, I'm buying the chart. It's like, does it matter what's on the chart? It just I've always struggled with that. I've always struggled with that.
I have too, and I've been wrong. I mean, that's the thing, is that I'll just admit it. When I start to overthink all of the details and the potential risks, I've been getting it wrong in terms of my expectation of what's going to happen. So do you just ignore your instincts, you ignore your inner skeptic, and go with the flow? And at what point does that lead to the next turn in the cycle?
That's where the gains of the last decade have been. Just sort of ignore your doubts and hold your nose, shut your eyes, and keep buying. This year, a great example of that to some extent. We'll talk about energy a little bit later. Capital returns from BP, following the likes of Shell, Total, Exxon, and Chevron. All of that coming up with Elise Ossenbar of JP Morgan Global Wealth Management. Your equity market just a little lighter this morning from New York City. Good morning.
The market is broadening. It's moving into other more value-oriented parts of the market. The names that have not been bid up are starting to participate more. It's about avoiding the euphoria and looking at the true fundamentals. Personally, I think yields start to come down over time. Right now, this is a market that is feeling like a recovery trade. It's probably not the recovery trade.
Brian Levitt, global market strategist at Invesco. Credit to the people who got this market right. Brian's one of them so far in 2023. Another one is John Stolfus of Oppenheimer, who's now looking for something close to 5,000 on the S&P 500 by year end. Citi now looking for that by mid-year next year. They're also looking for an earnings growth re-acceleration as well. So the bulls in the last 24 hours getting more bullish, it seems. In the equity market at the moment, on the S&P 500, we are negative on the S&P. We are softer. We are down by, let's call it, 1/3%. No real drama here. Captured in the bond market by not doing much at all on a 10-year at 396.49 in the FX market. The euro just a bit weaker here by 1/4% on the euro side of things, 109.70. Just a brief quick look at the pound. Pound sterling cable, 128. So that's the pound against the US dollar, 128.11. We're negative by 0.2%. At least for a little bit later this morning, you and I are going to talk about home price in the UK in about 10 minutes time. So we'll save that conversation. But the Bank of England coming up later this week. And Kit Jukes of SocGen basically saying sterling's vulnerable if the Bank of England doesn't hike by 50. There was some speculation that maybe the next move would be 50. I think that's died down a bit, and we're now looking for 25.
And it's because inflation has surprised to the upside. If you look at mainland Europe, you are seeing it also surprised to the upside. There are all of these labor issues and concerns about how much wages are increasing in London, in the UK more broadly. So at what point is this a credibility issue? At what point do markets start really pushing back against how much conviction some of these central bankers actually have about fighting inflation versus trying to avoid some sort of hard landing?
Based on the communication from the ECB and the Federal Reserve in the last week, I don't think they've got any conviction about anything.
Correct.
The hawks, the doves, none of them seem to know what's coming in September. Pick a hawk on the Governing Council of the ECB right now, can't commit to September. Pick a dove on the Federal Reserve right now, can't commit to September. None of them seem to commit to anything at the moment through the next month.
Have you noticed that markets have stopped caring? That a lot of people who we talk to say, I'm so sick of this conversation. Honestly, we're in charge. The data's in charge. We can interpret the data. They're going to follow us. They no longer are trying to tamp down some of the animal spirits that might be coming up. It's no longer a concern for them. That seems to be the feeling because the Fed as a risk case doesn't seem to be anywhere in these notes that are upgrading the forecasts for S&P targets.
Sanofi Desai's one of them over at Franklin Templeton, who was just like about time. The central bank haters, or rather I would say the haters of central bank activism of the last 10 years, just want them to stay at 5 and go away. Just sort of go away and disappear and let things function, if they do function. Jordan Rochester joins us now, G10 FX strategist over at Nomura. Jordan, wonderful to catch up with you, sir. Let's start with the Bank of England later this week. Is it 25? Is it 50? Is it what the ECB and the Federal Reserve delivered over the last week, which is a lot of communication about a ton of nothing? What is it?
A ton of nothing. Well, in terms of the Bank of England, we think they'll do 25. And the problem, John, for sterling is that there's about 32.5 basis points priced for that meeting. And that's going to move sterling. Now, it's not too much. It's not like a 50-50 chance of them going for a 50 basis point hike at this meeting priced in. But you saw with the RBA overnight, when there's around 8 basis points or so priced in for potential hike and they don't deliver, it can see a big move lower in the currency. So it could be the case that on Thursday we have Bank of England doing 25. It's too early for them to declare a victory lap. That's the thing. So we think there's going to be another few more hikes to come, maybe 75 basis points overall from where we are now today, this year. And that's the reason why sterling has relatively traded quite well. It's become a carry trade, John. It's one of the highest carry currencies in the G10. But all the charts we follow that tell us where inflation's going say it's going to slow down quite noticeably. So the goods sector, John, really going to slow down. Disinflation is here. The problem with the UK was services inflation. Our indicators suggested it should have gone down starting around a few months ago, and it didn't. But the good news is the last CPI print was possibly the peak of service inflation in the UK. That's why the Bank of England might take note of that and say, actually, there's some early signs that policy is working to slow down that sector. But it's just one data point. We need a few more CPI reports until that victory lap can be declared.
On this side of the Atlantic, we've had a similar conversation about whether the Federal Reserve is sufficiently restrictive. When you put everything together that you've just said, Jordan, can you draw that conclusion that the Bank of England is sufficiently restrictive?
I think they are, John. We're seeing evidence in terms of PMI input prices, supply side, all saying it's restrictive. Demand is slowing down, retail sales. All these sort of indicators are nowhere near as strong as what they were last year. But a lot of the analysis that goes into it sometimes just proves wrong in terms of the hard data. So the PMIs have been very weak on the manufacturing sector, but the industrial production figures haven't been as weak. The soft versus hard debate. So if you're looking at hard data, you're looking at realized inflation, you're the Bank of England saying we need to do more. But if you're in my space, if you're looking at the forward-looking indicators, they suggest, yeah, we are pretty close to being sufficiently restrictive.
That's over in England, where John was mentioning UK housing prices, which dropped the most since 2009, as you do see these rate increases, and we will talk about that later. Over in Europe, in the European Union, there is a question around whether they are sufficiently restrictive at a time when core inflation has exceeded headline CPI, the most going back to 2021, and at a time when you're starting to hear a little bit more of a dovish conversation from some of the members there. Can you still get bullish and long euro versus dollar if you do have that kind of shift, even among the hawks?
Indeed, we've had a shift already, and that's kind of why euro dollar has really fallen from the 112 handle to where we are today, just below 110. We've had various moments this year where it felt like euro dollar might break to the upside and to the downside, but the pain has been this range that we've had for most of 2023. We need a trend, and these false breakouts are just mutton dressed as lamb. We need to have some sign that either the US disinflation story is strong enough and we'll see that dollar weakness, or that the ECB perhaps doesn't need to cut rates at all next year, or if they do, towards the end, Q4. If we get that sort of story, then euro-dollar can be supported from the rates angle. But the problem at the moment, Lisa, equities are rallying, which is a reason to buy euro. It's the reason why we are long euro. We're looking for 114 by the end of September. But oil prices are picking back up, and the rates market in the EGB space have softened in terms of what's priced for the ECB by year end. We think they're done. We think that's possibly the last rate hike by the ECB. So the little bit of market pricing that's left for year end will be disappointed. It's not too much. We are pricing less than one rate hike now. But that is a drag on the euro. But if equities go to 5,000 in the S&P, like your previous guests were talking about, then the only way is for dollar weakness in that environment, in my view.
How disruptive could higher oil prices be, and natural gas for that matter, given some of the recent disruptions and costs on carriers?
The biggest headache I have right now is oil prices, I would say. It upsets the apple cart for sure, because the story is about US disinflation. Energy, before this oil price rally, was down 40% year on year in the US. And if it had stayed at those levels before we had this rally, it would have really dragged down US CPI. But now we've seen retail gasoline prices in the US pick up by 5% towards the end of July, and it could go further. If we break $90 a barrel in oil, I think central bankers will be too cautious, and they'll say, actually, we don't need to even discuss about cutting rates at all. We need to stay higher for longer, or even surprise with another hike this year. We think both the Fed and the ECB are done. But if we have oil go to $90, let's say it goes to 100, that's clearly a mixture of supply concerns, but it probably is due to demand picking back up in a surprising fashion. That will see a few central banks have to turn hawkish in the second half of this year, which we don't really expect. We think that most central banks are close to the end of their cycle. But if we get to 90 to 100, Lisa, a lot of things will have to change in the narratives that are out there.
Jordan, I've got 30 seconds. Is it too early for Aston Villa predictions for next season?
Well, look, I think we're now a top 10 club. That's what we can say after last year.
OK.
That's a massive improvement of where we were when we had Gerrard.
Jordan Rochester, Nomura, with a subtle dig at Steven Gerrard, of course, the legend out of Liverpool. Jordan, appreciate it, sir. Thank you on Aston Villa. TK not here because he's dealing with the transfer of Harry Kane, potentially, from Tottenham to Bayern Munich.
How is he dealing with that?
Taking it really poorly.
Oh, is that
That's how
exactly
he's dealing with it.
You called him up for some
also
therapy.
got this yesterday, I have to say, not being covered extensively and should be. And we're going to talk to Anne-Marie about it a little bit later. Governor Ron DeSantis of Florida unveiling his Declaration of Economic Independence. Might be some echoes reminiscent of what the former president said back in 2016, was it, on the campaign trail?
Yeah, talking a lot also about the Federal Reserve and the potential independence therein, or lack of it.
AMH has read through the whole document and listened to the speech, the address from the governor of Florida yesterday. We'll catch up with Anne-Marie in the next hour. Up next, Sarah Hewen of Standard Chartered Bank from New York. This is Bloomberg. Just about squeezed out a second day of gains on the S&P 500 in yesterday's session. This morning, slightly negative on the S&P 500. We are softer by 0.2% on the S&P. On the Nasdaq, we're down by 0.3. A monthly gain, though, in the month of July. Fifth straight month of gains on the S&P 500. That monthly winning streak, the longest going back to 2021. It's been pretty neat. It's been pretty tidy. In the bond market, we look like this. 2-year, 10-year, 30-year. The 2-year yield, 487.25. The monthly move on the 2-year, down about a basis point. I made that one of the smallest monthly moves of the year so far. 2-year barely did a thing. And maybe, Lisa, that's why there's a little bit of enthusiasm returning as well, because you get that stability around rates. And to your point, the Fed starts to back away on top of the data showing some resilience. Good news all round.
And it means that the strategic ambiguity that we've heard from central bankers means stop worrying about them. Don't even think about them, because right now people aren't worried about the tail risk that has been one of the main tail risks of the entire year, which is that the Fed will kill this. Now they're just like, no, I think we're good.
12 months ago, they hated a rally. They were pretty outspoken about it.
Exactly.
12 months later, barely on the radar, it seems.
They're not going to jawbone this rally down, which I find interesting, and people are taking comfort from that. So they're not on the radar as much as they used to be as a potential tail risk, even as you mentioned earlier, credit conditions are tightening at a steady pace, not a break in the credit transmission mechanism. When does that start to matter?
10-year at the moment, just in and around 4%. Let's push it through foreign exchange. Take a look at the euro. Some pretty dreadful data out of Europe over the past week or so. To break a 110 again, 109.73. Euro dollar negative here by 0.2%. Under surveillance this morning, the latest manufacturing data out of China disappointing once again. The Caixin PMI falling to a 6-month low and below the 50 level that marks the difference between expansion and contraction. This follows the official manufacturing PMI that came out earlier this week, also showing a decline in China's factory activity last month. That data out of that country, that economy at the moment, Lisa, cannot get a break.
It cannot get a break, and it's led by manufacturing. It will only get more difficult for China, which is what people are talking about, if commodity prices continue to rise as they have, given the amount that they have to consume. Meanwhile, this big question remains, what's the support going to be like from policy officials? They've pledged support. We haven't gotten that many details. There's been minor rate cuts. There hasn't been some sort of full-fledged recovery trade for the housing market. At what point can they stimulate this economy while still maintaining their goal of reducing leverage?
Or are you pushing on a string? Are we at that point right now where we're starting to see some features of a balance sheet recession start to grip, coming out and making it easier for people to buy new homes? Do they want them? Do they actually want to lever up and buy another property? That's the moment I think we're trying to work out whether we're at in China at the moment. I was going through some of the numbers around the property market. The value of new home sales by the 100 biggest real estate developers in China, down about a third, down 33% or so from a year earlier. That's a problem. You've seen what's happened with developers, both in the debt and equity markets over in China in the past couple of days. We are holding on to this statement from the Politburo from last week, and it was what they didn't say that a lot of people are entertained by. It didn't have the reference to Xi Jinping's mantra that homes are for living in rather than speculation. But are they going to be able to encourage that investment in the market? That remains to be seen.
Especially while continuing to double down on Xi Jinping's goal of trying to move to a middle-class, more consumption-based society and less with the trappings of the previous growth cycle, which really was about inflating housing prices, inflating some of the infrastructure.
That's China. I wanted to talk about this story as well, going into payrolls on Friday. Something we'll be watching. Just more job losses potentially. CVS preparing to cut about 5,000 roles to help reduce costs. This from the Wall Street Journal this morning, reporting that most of the roles will be in corporate positions. The company saying it doesn't expect customer-oriented roles in its stores, pharmacies and clinics to be affected. So rather like yellow yesterday, Lisa, is this more about CVS and their industry than it is about maybe what's happening in the broader economy?
CVS has been a specific story, and a number of the large drugstore chains have faced some particularly specific headwinds. That said, to me, the trend is middle market, middle office types of workers. The corporate office is the one where there are people getting cut, not necessarily the front lines of consumer-facing employees. To me, this has been the theme that we've seen so far, because it has been a white-collar recession in the labor market, not necessarily a blue-collar one, or people in service sectors. At what point does that start to show up in the data in some sort of more material way if the people in the corporate roles are getting paid more? This has been one of the big questions underpinning this labor market.
Payrolls Friday, just around the corner. The estimate at the moment, about 200K. I promised you we'd talk about this story a little bit earlier, so here it is. Home prices in the UK falling at the fastest rate since 2009. The Nationwide Building Society said prices fell 3.8%, slightly less than the 4% that economists were looking for. But this drop, of course, comes as the Bank of England is set to hike interest rates once again later this week. It's starting to bite, Lisa. More quickly in the UK, of course, because the mortgage market is so different. Starting to bite more quickly there versus, say, the United States.
Which raises a question about whether we're not seeing the effects yet in the U.S., whether it's delayed or whether it's postponed indefinitely because of the 30-year locked-in mortgages. Is the UK, in other words, a test case for some of the other areas, the other regions where rates have gone up significantly, but there are lag effects? Or is it something that is more specific because of how some of these mortgages are structured? I don't know the answer to that, but it's something that a lot of people are saying when they say, well, just wait and you'll see that slow down. You'll see prices of homes come down. People are not saying that anymore because there have been all of these offsets. Is the UK a leading indicator that that still holds true eventually? It just will take a while.
Bear in mind, it is taking a while in the UK as well. So if you think about a popular mortgage right now, 2-year fix, mortgage rates above 6%. If you take the effective rate on the average loan of outstanding mortgages right now, it's something close to 3%, up from about 2% when they started hiking. So it's taken a while, even in the UK, but it's happening. And you can see the direction it's moving in. And if the Bank of England stays at these levels, never mind going further, and more mortgages come off and more people have to start taking more financing, that effective rate, that average rate, is going to start creeping higher and higher and higher.
And it couldn't just be this sort of gentle slope upward. There could be a moment, either a catalyst, a forced sale kind of moment, where suddenly those prices come down more quickly and you start to see a more sustained increase in the average mortgage rate. So these are some of the things people are looking at to understand the transmission mechanism of raising rates, which hasn't had the impact that a lot of people were expecting.
We can have that conversation right now with Sarah Hewen, Europe and America's research head over at Standard Chartered Bank. Sarah, wonderful to hear from you, as always, and welcome to the programme. Is it starting to bite in a more material way in the United Kingdom, the transmission from higher interest rates at a central bank into the broader economy?
I think it is starting to bite, but I think we still have to wait for the full impact to be felt. Remember that only about a third of households have mortgages, so you're really targeting a certain part of the consumer market that with these higher interest rates. Obviously, businesses are facing higher rates as well, but so far the data, the spending data from the UK have not been affected as badly as might have been expected given the sustained rise that we've seen. Now, I mean, consumer confidence has fallen. Consumer confidence is weak. We're just starting to see the signs of weakness in the labour market. And I think that that's going to be the element that really has to change before we do see these higher interest rates starting to have a material impact on consumer spending in the UK economy.
Jordan Rochester was just on, and he was saying that he thinks the Bank of England is sufficiently restrictive and may not have to hike again, even though we are seeing inflation at a sustained pace, particularly led by the services sectors. What's your belief? I mean, do you think that they are sufficiently restrictive or that they have no choice but to make inflation their priority in order to restore their credibility?
I think this question about credibility is absolutely key because, of course, they've raised rates quite dramatically over the last 18 months or so, and the impact of that is not fully going to be felt for another 6, 12, 18 months. But in the face of inflation, which is so far away from the inflation target, it's really difficult for policymakers to call a halt at this point. I mean, we're getting hints of that in the US. We're getting hints of that from the European Central Bank as well. But for the Bank of England, inflation is still high. It's coming down. But the difference, I think, is that we're seeing clear wage pressure, potentially a wage price spiral starting to become embedded, and policymakers can't afford to let that get a hold of the economy. We think that they'll raise rates 25 basis points this week, but we'd expect another couple of rate hikes after that in September and November before they can really feel that they've done what's necessary.
Do you believe in the lag effects, or do you think that interest rate rises just are not that effective anymore, given how companies, how consumers have adapted to the expectation that eventually rates would go up and to lock in incredibly low rates for a very long time?
It is different this time around. If we go back to the 1990s, which was when we last had a really dramatic impact on the housing market from higher interest rates, it's a different situation now where many mortgage holders have fixed rates, but it just means that the impact is delayed, and that makes it even tougher for policymakers. As people roll off their fixed rate terms, they have the choice of fixing at a much, much higher rate or taking a punt, going for a variable rate on the hope that rates won't stay high for too long. And I think that the impact is as significant, but it's just spread over a longer time period. So that is, I think, going to become more of a feature of the economy, particularly next year. We think there is a high risk of the economy going into recession around the turn of this year, and certainly into next year. We've got a negative GDP for the year as a whole.
When you take a look at the recession expectations in the U.S., a lot of people are pushing them out and saying they're not going to happen. In Europe, people are already seeing it in Germany. Are you getting more discouraged by the expectation in Europe right now, just based on what we're seeing from Germany, but also the economic surprises that have come in disappointing again and again versus the upside surprises in the U.S.?
Yeah, I mean, in Europe, the survey data.
I think we lost the connection there with Sarah Hewen, the Standard Chartered. There's a theme this morning.
It's just we stop people in their tracks.
Things aren't breaking in the market, though. That's been the theme so far. Hopefully we'll work out what's going on. We'll catch up with Guy Labas of Jenny Montgomery Scott. Guy, if you're listening, hopefully we can talk about fixed income around 7:30 Eastern time without your connection breaking. We've got some earnings for you breaking across the terminal. Let's share them. Caterpillar beat on the top and bottom line. Caterpillar second quarter EPS 5.55, the estimate 4.54. Revenue for the second quarter 17.32 billion, the estimate 16.39. A beat, an upside surprise, an upside surprise. Then this, the outlook for the third quarter. Sales and revenue to be lower than the second quarter. The year's adjusted operating margin will be close to the top end of the range. So there's a beat here, but I wouldn't say there's a raise, that's for sure. We're down about 0.75% on Caterpillar in the pre-market, Lisa. Basically, they're warning that you're going to get a slowdown in the third quarter. The second quarter, though, I think we've got to talk about where we have been before we talk about where we're going. It's defied expectations of a slowdown in a big way.
We haven't seen the recession get as deep as many people thought in some of the agricultural areas and some of the areas that Caterpillar really does specialize in. If you think about construction and how much home builders have actually been active, if you think about a lot of the farming products, a lot of the aspects that Caterpillar caters to. Going forward, though, and this is important, at what point do you see that steam roll over just as other areas of weakness come into play, which is the reason why you're not seeing a bigger gain by some of those shares?
One pocket of the market that you know has done tremendously well so far year to date has been the airlines. Discretionary spending has been robust, resilient, and anyone living at an airport at the moment, going through one, stuck in one for a long time. I think we've all been there. This isn't a complaint. It was about to be one. But I think you've got a decent idea that things are really, really good right now for the airlines in America. So in line for an airline is basically a miss at the moment. And what you get from JetBlue is in line. Second quarter EPS 45 cents, the estimate 44. Revenue for the second quarter 2.61 billion, the estimate 2.61 billion. So the analysts seem to have done a good job this morning. They still see demand as being robust and healthy, using all the right words, Lisa, but the stock's getting hammered, down 7%.
I don't understand this. I've been looking for why, and I don't understand it. They say we remain on track to deliver a profitable year, record revenue performance. Where's the negative here?
Give me more. We want a beat and a raise, Bramo.
Is that really what this is?
In America.
Is that really what this is? Is that how high the bar is at this point?
No idea. Let's see how this stock evolves through the morning. We're down about 7% right now. From New York City, good morning.
We're seeing very strong gasoline and very strong jet fuel demand. People are traveling, people are spending on services. And then on the diesel end of the spectrum, we see that as being weaker than people had expected. China is still growing. It's grown 3% in the first half of this year, obviously well short of what people would expect from China, 5 to 6%.
That's the unknown for the back half of this year, the kind of stimulus we get out of China, whether it bites and can deliver a little bit more of a lift to that economy in the second half of 2023. Disappointing, a move to the downside in a way that wasn't anticipated 6, 7, 8 months ago when we started talking about the reopening. That was the BP CEO, by the way. Your S&P 500 futures look like this morning, negative on the S&P, down by about 0.2%. Yields a little bit higher by a single basis point, 396.89. And in the commodity market, crude just a lift over the last month, a stellar month of gains for crude, Lisa. WTI this morning, $81. We're down there by 0.6%.
We just had the biggest monthly gain going back to January of 2022 at a time when a lot of people are saying if oil prices remain stable or remain about here, that'll be fine. But we heard Jordan Rochester earlier say they go to 90, they go to 100. It could cause central banks to rethink their rate hiking cycle and actually raise rates again.
Do they want to chase the crude price?
You've asked this before. I was thinking about that. You were saying, are they basically just looking to raise rates to fight oil prices?
I've always struggled with that.
But how much of a...
We used to joke back in the central bank activism days, and you and I think probably talked about this a few times, that they shouldn't have been buying bonds. They should have just bought barrels of oil.
They did.
You know,
the strategic petroleum.
No, I mean the central banks.
No,
but, you know,
kidding.
if they really wanted to get inflation up, and that's what they cared about, just sort of prices for the sake of higher prices, then they could have done that.
There is a question about how much lower oil prices has underpinned the decline, the sort of macular disinflation that we've been seeing in certain areas of the market, just because of the bleed through in pricing across the board of higher oil prices or lower prices. I'm thinking airlines, I'm thinking even shipping things. So if that starts to tick up again, how much does that influence the entirety of the inflation picture in a broader way than just simply the energy price input?
When it comes to consumer expectations, there's one price that shapes things almost exclusively. And in my favourite indicator that you get from the University of Michigan with inflation expectations, I think there's a strong lead there that crude and gasoline prices shape that almost exclusively, don't they?
I think that if you chart the price of gasoline and you chart the expectations for inflation for the University of Michigan survey, there's a...
You notice that I'm calling it my favourite read now because I'm hoping they call me one day.
You've already told them you're going to give them some sort of crazy number. Of course they're not going to call you.
Let's see if I get a phone call. Great story yesterday from our colleagues here at Bloomberg News that according to people familiar with the matter, Exxon is in talks with Tesla, Ford and VW and other automakers about supplying them with lithium. Kevin Tynan joins us now, senior automobiles analyst at Bloomberg Intelligence. Kevin, can we start with that story? An oil producer going in more into the lithium business and supplying these auto manufacturers. What's this look like going forward?
Well, this is what we've been for 5+ years. You say electric vehicle things and hope it gets you the valuation. We're still a long way from, mining that lithium, getting it to the manufacturers, building that supply chain. So, yeah, I mean, I think there's a group of suppliers, even in auto parts, that are, anything from all in on electrification to trying to figure out how they're relevant in the future to technology agnostic, meaning it doesn't matter what the drivetrain is, tires, glass, seats, things like that. So I think you have this bucket of suppliers that are trying to figure out how to be relevant in the next iteration of the auto industry.
Kevin, how disconnected are things between the goals of governments across Europe and the United States and the infrastructure that currently exists?
Yeah, look, I think there's a lot of issues in terms of, when a lot of times we just hear about tailpipe versus no tailpipe, and I try and go back to shovel in the ground to disposal of a battery at the end and really think about the entire value chain the whole way. So, look, the infrastructure is certainly an issue, but I think there's a lot more too in terms of back from where the materials are coming from, where they're processed, what they cost, the value of them relative to the internal combustion technology that already exists. And the issue is really getting to profit parity between the two technologies, not necessarily the price parity, Because if you have one technology that's significantly more profitable than the other, which right now is internal combustion, the automakers are going to focus on that and do more than that and drive their profitability with that technology, not the unprofitable one. And that's why this transition's a little bit messy, especially here in the US, where we have a little bit less subsidies to the manufacturer or penalties to the manufacturer driving consumer demand.
Well, do consumers really want electric vehicles as much as people previously thought? And I ask this after Ford moved away from some of their high projections of how many electric vehicles they'd have on the road.
Yeah, and I'll tell you, Lisa, I've been saying this for years. It doesn't really matter what the consumer wants or doesn't want. If it's not profitable to an automaker, they're just not going to build it. And unless there's a penalty for not doing it or there's a subsidy that makes you whole on your income statement, you're going to move at the pace of profitability, or you're going to go where the profitability is. So I think there's a little bit too much put to what the consumer wants versus what the manufacturer wants, because dealers can't sell what they don't get from the manufacturers. Consumers can't buy what the dealers don't have. And left to its own devices, which is profitability right now, you're going to get a very slow movement, slower here in the US than you do in Europe, where the penalties are more significant, or in China, where the subsidies are much more significant. And that's just the way this market's played out over the past couple of years.
Is the physicality of electric vehicles truly that much more efficient than combustible engines, given the fact that it is so much more complicated to mine the lithium, to get things to the floor? It's expensive, it's complicated, and it entails a lot of materials. Is it more efficient?
Yeah, and you know what? That's a question I think we need to be asking more. I don't have an answer, but anytime you bring up the two sides of that argument, one side science is right and the other side is wrong, and you get both sides saying the same thing, which is our science proves this, our science proves that, and yours is wrong. And I agree, like I said, I want to go from shovel to disposal and understand how much better this really is. And I think if you come to that conclusion that the net benefit is there but not as significant as is priced into the market, then this just becomes about capitalism, not climate.
Kevin, just a final question. The demand for this stuff, what does it look like at the moment? We've seen price cuts from Tesla, from Ford. What is the demand for EVs at the moment?
Yeah, look, this is the cyclicality of the market, right? And when you get to a point where you're saturated in terms of market share, this is what happens. You build or have too much capacity, build too many things, have to figure out how to sell them. And keep in mind, too, the difference with Tesla, Rivian, Lucid is that they don't have a franchise dealer network. So they're not collecting that revenue, right? They're booking that cost of goods on the build of the vehicle, but they're not collecting that revenue or booking that revenue until it's delivered to the consumer. Where a franchise dealer base, it's a working capital management, but those manufacturers are booking that revenue on the sale to the dealership. So when you look at Rivian or Lucid specifically, who's delivering about 60% of their output, you have this inflated cost of goods and a very low revenue per unit, and it makes you unprofitable at the gross line. So that's where you get price cuts, right? You have to keep the production moving. You have to get product in the hands of consumers. And when that backs up because of macro environment, this is what you get. You get the auto industry looking like the auto industry has looked like for 100 years.
Hey, Kevin, thank you. Kevin Tannen there of Bloomberg Intelligence on EVs and the auto manufacturers in the United States. In the next hour on Bloomberg TV and on Bloomberg Radio, we'll catch up with Elise Ossenbar of JP Morgan Global Wealth Management. We'll talk to her about the equity market. And we'll talk about this too with Anne-Marie down in Washington, D.C. A declaration of economic independence from the governor of Florida, Ron DeSantis. We win, they lose. We need to talk about who the they actually are, Lisa. We win, they lose. A declaration of economic independence and a little bit of an echo from what we heard from the former president, Donald Trump, back in 2016. So that's the politics. And on the market, upgrades from Citi on the S&P 500, looking for 5,000 on the S&P by the middle of next year. We're on record high watch. And then you've got the likes of John Stolfus over at Oppenheimer saying we can hit that record high before the year is out.
4,900 with basically a 20% gain for 2023, which was supposed to be a terrible year.
Plenty of earnings in the mix as well.
Yeah.
Second quarter for Uber just dropped. 9.23 billion. The number, the estimate, 9.34. More on that in just a moment. Your equity market negative here, trying to recover. We're softer by 0.16% on the S&P 500. Yields essentially unchanged on a 10-year, 396.69. This is Bloomberg.
They're ignoring parts of the data that may be pointing to a more significant deceleration.
The market is broadening. It's moving into other more value-oriented parts of the market.
I mean, the big tech has clearly done a lot of impressive lifting here.
I do think the market's a few points overvalued.
I do think our prospects are good long run.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market on the S&P 500 trying to recover. Still slightly negative on the S&P by 0.15% on equity futures. Going into the opening bout, a lot to chew on, including upgrades on the equity market from Citi and from Oppenheimer as well, and some economic data out of China. And once again, guess what? Disappointing, Lisa. Downside surprises across the board out of China recently, and manufacturing in contraction territory. Even if there are subtle beats here and there, it's moving in the wrong direction.
Let's just put this into context. Coming into this year, the biggest potential positive risk to markets, upside risk to markets, was a reopening of the Chinese economy, a reacceleration, fueling growth all around. What have we gotten? The economy in the U.S. has been better than expected. The economy in Europe, better than expected. China came back online. It reopened. And oh, yeah, are they heading toward deflation? Are they looking at a lost decade akin to what had happened to Japan due to structural shifts? A massive narrative change.
U.S. dominance, both in the equity market and in the economy. The U.S. economy has been far more resilient than people thought it would be. Going into payrolls on Friday, this is what we're looking for. Think about this. On Friday, 200K is the median estimate in our survey right now for the headline number. 3.5% unemployment. In and around is once again the estimate in our survey. Think about where we were 12 months ago. Predictions for where this labour market would be? They were talking 4, 5. Could this economy stand up to interest rates of 5.5%? And here's the Federal Reserve flirting with maybe going once or twice again.
And we're not necessarily seeing the weakness. Maybe we will today at the job openings data that we get at 10. But people are looking at help wanted signs all over. I see them still, particularly in service sectors. Even companies that are trying to cut back aren't cutting employees because they are so scarred by what happened during the pandemic. They don't want to have a dearth of employees during the recovery. So at what point can you say, yes, inflation could keep coming down, even without that pain that Jay Powell talked about last year at Jackson Hole, without that pain in the labor market in any sort of meaningful way?
Is that where Tom is today, interviewing?
At what? An ice cream parlor?
Where did you see the help wanted signs?
All over. Going on vacation. That's where you see all the help wanted signs, because everybody's going on vacation because that's what you do, and that's why we've seen these gains.
That's what you do in the summer. Gets hot and you go on vacation.
Maybe, yeah, exactly.
Right.
Let's move on.
Maybe TK is on vacation. He always does this to me every time I take off.
Yeah, well, he
gives me hell when I'm away, and actually discloses where I actually am.
Yeah, well, it's true.
Which I don't appreciate.
Well,
he names the place.
Yeah,
He's this far away from naming the hotel.
I get people coming up to me saying, "Were you really on a cruise in Norway looking at fjords?"
So I actually thought you were in Norway on a cruise.
Well, that's what he told everybody. So people were like, "How is Norway?" And I was like, "I was not in Norway." "How is a cruise?" "I was not on a cruise."
You were in Alaska.
I was in Alaska,
not on a boat.
But not on. Well, I did take one day.
You took a boat. Oh, so
and we
you did kind of cruise
and stuff like that. But it wasn't a cruise. It was like a 6-hour.
Like a boat tour.
Okay, it's not a cruise.
It was a boat tour.
It's a boat.
What was the average age of the people on the boat?
It was all over the place. It was not. What did you think?
Well, no, just that if it's a cruise, usually that average is
much higher.
Much higher.
No, there were families. There were people our age. It was all everything. Yeah.
Okay, just checking. Equities right now on the S&P 500.
I'm sure everyone really wanted to know.
0.1%. Just trying to figure out. I think if the average age is like 70 plus, it's a cruise. You're on a cruise. If you're on a boat and that's the average age, you're on a cruise.
Okay,
all right.
That is
in the bond market, your 10-year 396.69 yields higher, Lisa, by a single basis point.
Totally disagree with that definition. 10 a.m. though is the economic data that we're looking for. U.S. JOLTS data, the job openings expected to come down just a touch. Unclear how much this is really going to influence people's views. ISM manufacturing data comes out at the same time. Do we see the ongoing manufacturing recession in the U.S. akin to what we saw in Europe earlier today and China, or do we start to see a bit of a rebound? rebound. 10 a.m. Fed speak, including Chicago Fed President Austin Goolsbee. Yesterday, he was talking to Yahoo Finance, and as John mentioned, he didn't commit to raising rates in September, but seemed like he might even entertain it, even though he is dovish. But to me, I thought it was interesting that he sounded like he was calling victory, saying a soft landing is this golden path that would be a triumph, and it's certainly a possibility at this point. So do we start to hear this kind of tone from increasing number of Fed officials?
I mentioned this in the last hour. If one of the biggest doves on the committee doesn't know what to do in September, and one of the biggest hawks on the governing council at the ECB doesn't know what to do in September, it does speak to the kind of moment we're at right now. Zero guidance from anyone on anything.
That, I think, is the only takeaway you can get from this, because right now I'm not going to necessarily say he isn't decided. My guess is he's probably leaning against raising rates in September. That is what his rhetoric is saying. But he's not going to give any guidance because he doesn't have to. They're not trying to job on the market into anything, which has been really interesting. The earnings today continue with a lot of consumer-heavy brands, including Uber, which just came out, Marriott, JetBlue, all before the market, and Norwegian Cruise Lines. We'll ask them what their average age is. I'm sure that it is not 70, especially if it's Disney Cruise. Caesars Entertainment and Starbucks after the bell. Just to give you a sense of Uber, and Marriott did just drop, beating expectations. Shocker, given the fact that everyone's on vacation. Second quarter revenue, $6.08 billion versus a $6.02 billion estimate. Uber coming in just shy of expectations, dragged down by its freight service. Revenue declining. Why? Because people aren't shipping as much stuff. They're not ordering as much and they're not sending as much stuff. So I'm looking at for stuff like this, and costs are going up to get drivers back. And that's maybe why your costs are going up, Jonathan.
I was distracted. The average age of a cruise passenger is 47 years old, apparently.
Oof.
High
Boom.
40s. Didn't know that.
Well, there you go.
Didn't know that.
Would you like to...
Nope. Lisa Abramowicz joins us now, investment strategist at JP Morgan Global Wealth. Don't listen to me about cruises. The stocks are doing great. Elise, it's good to see you.
Great to see you.
Vibe shift. Let's talk about the vibe shift. We're not talking about recessions. What are we talking about?
Look, we concede at this point that we came into this year probably too pessimistic on the macro front. What we're seeing is this resurgence, or rather perseverance, of the resilience in the U.S. economic backdrop. And I think that's been driven by a handful of different dynamics, but it seems like a lot of people are kind of coming around, facing the music, and trying to figure out where we go from here.
Equity market rallies usually do that. People start to jump on board, and now they're thinking about where else they need to be, what's missed out, what's lagged, and they're shifting towards the cyclicals. Banks had a great month in July. Do you see reason for that to continue?
We do, actually. So I think it's really important to think about the anatomy of the year-to-date equity market rally. Everyone at this point knows that it has been predominantly driven by the mega cap complex that, kind of has been flying on the wings of artificial intelligence hopes, but we do think that this rally can start to broaden out. And that's a big reason why we've been encouraging investors to focus on the other 493 names in the S&P 500, which taken together are actually still trading at a valuation below their 10-year average.
What money are they going to use to buy these stocks? In other words, do you start to recommend that people take money out of money markets and put them into, the other sectors of the equity markets? Or are you saying to people that you have to have a balance? I mean, how does this sort of come to fore if you don't want people to necessarily cash out of big tech?
Look, cash is a great place to start. We know that a lot of our clients are still heavily overweight excess cash based on the anonymized client data that we look through for our mid-year outlook exercise. So even in light of this shift in our macro view that the Fed could possibly pull off a soft landing, we do still think that reinvestment risk is here. Come first quarter of next year, we think the Fed could be in a place to start gradually cutting interest rates, and we would much prefer that investors take that excess cash, extend duration, or start rebuilding that equity portfolio that they want to carry through the next cycle.
Does it bother you that you're looking at earnings yields on the S&P 500 that are the lowest relative to what you're getting on a 10-year Treasury going back to 2001? Does that raise some alarm bells that maybe valuations are out of whack and that bonds look better than some people are making them out?
Look, we continue to love core bonds. It's one of our highest conviction ideas, and it does bother me a little bit, but we certainly take it into account when we think through portfolio construction. I think investors more than ever need to be mindful of a goals-based or outcome-oriented approach, and if that means then that choosing core fixed income with yields at these current elevated levels is enough to get you to your long-term goals, then by all means. But long-term, 10-year plus time horizon, we still see the potential for stocks to act as that engine of capital appreciation in portfolios, so we don't want to sleep on the opportunity.
We started this conversation by talking about resilience, and about 4 minutes into it, you were talking about rate cuts. What are the factors behind resilience of the year so far? that you think are going to fade sufficiently enough that the Fed's cutting rates in early 2024? Can you identify the factors first and then just walk us through where you're seeing signs of weakness that you think will continue coming through that eventually are going to lead this Fed to cut rates?
Sure. So in terms of what's been driving the resilience, start first with the consumer. I think excess savings perhaps weren't drawn down as quickly as everyone thought they might have been, but we do see that kind of tapering to an end over the course of this year. You also have to consider that businesses and consumers both have been relatively insulated from interest rate pressures, given that they locked in lower levels of financing. And you've got these tailwinds coming from the fiscal spending front related to the, more than $2 trillion worth of infrastructure investment that's kind of, earmarked to be doled out over the course of the next 10 years. So those are the reasons for resilience. And you add to that what we've been seeing in the labor market, which is pretty favorable trends when it comes to labor force participation. But to the extent that growth continues to slow, and we are still calling for, flat to slightly negative growth in the first and second quarters of next year, maybe you do see a modest rise in the unemployment rate. And that, I think, continues to urge investors to heed some caution and not get too over their skis when it comes to adding risk.
How much does that really hinge on oil prices staying where they are and inflation continuing to steadily come down?
Look, I think oil prices are definitely kind of one of the, variables or X factors here. We'll be curious to see if prices do continue to consolidate higher. We're doing the work right now on our oil price outlook, but that could potentially change the outlook for the Fed. And we know, just looking at the past year of data, right? A year ago when oil prices had exploded higher, that's when you had consumer confidence hitting all-time lows. And so to the extent that we see that kind of rear its ugly head again, it could potentially weigh on the outlook and, bring a resurgence of bearish sentiment.
Brent Crude, 85. Elise, this was great. Thanks for joining us and thanks for coming in.
Of course. Thank you, guys.
Elise Ossenbaugh there of JP Morgan Global Wealth Management. This from Capital Economics just yesterday on credit conditions following the Senior Loan Officer Opinion Survey here in America, basically a survey of credit conditions to the broader economy. Despite the optimism surrounding the real economy's performance over the first half of this year, here's the punchline. Credit conditions have historically only ever been this tight during or in the run-up to recessions.
A lot of people are pointing out that this is the case. You have to say this time is different if we're not going to get a recession based on the level of credit tightening that we've gotten. Every time out of the 4 times since 1990 that this index was put into place that you saw credit conditions tighten to this extent, every single time there was a recession.
That's the call right now. It's been the call for most of this year. If you are just joining the programme, welcome to the programme. On the S&P 500, we are negative here by 0.14%. Elsewhere in the bond market, yields are a little bit higher at 397.49. Tons of economic data through this morning, Lisa, going into payrolls on Friday. ISM manufacturing, worth a look. Deep into contractionary territory, sub 50. And I guess the conversation's going to be around whether China can really get things going and deliver a move worldwide, because manufacturing at the moment across Europe as well, it's pretty terrible.
And we've been talking about what happens with the fact that we've seen a manufacturing recession and a services expansion. Which meets which? Does manufacturing start to recover and meet the services momentum, or do we see services come down and meet the manufacturing? What we've seen is a little bit of softening in the services, and we will get that later this week. But manufacturing still deep in contraction at a time when people are saying, well, start to recover already. Come on, let's go. We should be getting to the next part of the cycle. And so I wonder how long you can get this sort of dissonance.
That convergence. Mislav Matejka at JP Morgan has called for a while that he thinks that ultimately services come down to manufacturing. But we'll see. We'll see. Manufacturing data in the US, I think, has improved more recently.
What we saw from Caterpillar right there in the second quarter.
Define expectations.
And how much does the housing market really underpin this? Because you've seen the home builders really get in there and try to build a lot more supply. And that's been sort of the sleeper surprise of the year as well.
The housing market in America is just weird.
It is, right?
The whole thing's just weird.
Is that that's your professional assessment?
That's my professional assessment of the housing market in America.
I felt a vibe shift from you.
Weird. That's my vibe shift
I think
around
that, I think
a
lot of people would agree. It's been unexpected. I think that's the word that
if you're in
expect.
it and you own, it's fantastic, and you have that 3%. That's the dream. I talk about it all the time. Just go back in time. Maybe a year ago.
How do you feel about that?
I'm just lining up outside First Republic. I go inside and get a jumbo mortgage.
They pay you to buy a home?
Oh, 2% mortgage, something like that. That's the dream, isn't it?
Is it?
Yeah.
That's what you dream about?
Then I take all that money and park it in a cash savings account.
economic policy needs to be focused on making the cost of living more affordable and the American dream more attainable for American working families. And if you don't get that right, you cannot be successful as a country. And we cannot allow no longer the failed ruling class in this nation to dictate our nation's policies.
The Republican presidential candidate Ron DeSantis of Florida speaking at a campaign event in New Hampshire in the last 24 hours, a declaration of economic independence, some echoes perhaps of what we heard all those years ago in 2016 in the run-up to that election from the former president, Donald Trump. What is intriguing about this shift, though, if he stays here, Lisa, is polling Republicans right now, potential voters. The number one issue is the economy. Social issues are up there, but nowhere near to how high the economy polls. And you wonder if we hear less about woke and a little bit more about this kind of stuff from this candidate.
I don't know, though, if the economy issues that the population is worried about are the same that Ron DeSantis is talking about, given his emphasis on China and decoupling from China and saying that we need to take back control of our economy from China. Because if that ignites more inflation, people might not be as much on board. In other words, how do you sort of tie in some of the focus on economy with some of the goals in this particular economic plan?
A pretty strong language. America is in a state of decline, militarily, culturally and economically. People across our nation are collapsing under an economy that no longer works for the American family. Doesn't that just sound like candidate Donald Trump back in 2016?
Populist themes. That's
right.
Basically what you're hearing. And this has to do with even reducing student loan debts. Well, how does that pair with some of the calls against what we heard from President Biden? All of these issues, though, speak to a similar tone in this election cycle that we heard back in 2020 in terms of very populist and coming out and trying to cater to the moment of the issue, which is still the economy.
Let's get down to AMH. Anne-Marie, Bloomberg's very own chief Washington correspondent. Anne-Marie, can we start there? This didn't go unnoticed by the former president, did it?
No, certainly not. He now calls it, as he calls Ron DeSanctimony economics. So he's trying to needle Ron DeSantis. And you can see why, Jonathan, when you look in the polls. While Trump has this overwhelming support, you look at the CNN, New York Times, a national poll that was released yesterday. Yes, Trump has this overwhelming support, but the number two at the moment is Ron DeSantis, the governor of Florida. What every candidate wants to do on the Republican field is to get to that number two spot, because the hope amongst many of them is that if you can get to that number two spot, individuals further down the line will start to drop out and throw their support towards you. So Trump understands this, and that is why he's throwing a lot of shade at the governor. But you really hit the nail on the head, Jonathan, when you say this is also about a shift away from the woke policies we've been hearing from the current governor, and more about economic plan overall, tackling China. What do you say about taxes? It's very much so Republican talking points with a bit of populism as well.
You've been following the money. Where's the money going? To which campaign?
Well, at the moment, a lot of donors are on the sidelines. You do see some donors, like one of the Koch brothers, putting money towards going and ad campaigns about not electing the former President Trump, but about where the money is going at this moment. A lot of money is just waiting on the sidelines, and I think you'll see an influx of money come through after the debate. A lot of big donors want to see how these individuals are on the debate stage, and if it moves the needle in the polls. We can also point to the fact that where the money is going for the former president, he still maintains a huge lead when it comes to those single individual low capital donations, $20, $30, $50. Interesting about the Trump campaign is that a lot of that money, actually the bulk of it, $60 million worth, is going to his legal fees $40 million worth is going to his legal fees and the fees of his associates. And potentially that is going to become much harder as he faces a third indictment, which we could see as soon as today or later this week.
You know, I keep thinking about some of these polls and things like the economy or democracy are huge polling issues. And I have no idea what they mean or exactly what, aspect people are pulling out. For example, with the economy, John, when you take a look at that, are people talking about inflation? Are people talking about China? Are people talking about what's going on with woke corporations? Right. That's one of the big issues.
Well, when it comes to democracy, both sides think the other side is a threat to it.
And that's the same thing for the economy, right? Because both sides want their ideology represented. But Anne-Marie, when people are talking about that, what is it? Is it inflation? Is it fighting woke ideology in corporations, which is one aspect of this New York Times poll with respect to Republicans? Or is it China?
When you look at why Republicans want to talk about woke ideology creeping into the business world, this is more actually a social issue, I would say, than an economic issue. When you look at these polls, inflation has remained top of mind of American voters. Yes, inflation is starting to cool, but it is still at that higher base level. And this is what a lot of Americans have been struggling with. So when you look at the rematch between, also a potential rematch between Biden and Trump, what the New York Times Siena poll shows is that also a lot of individuals are starting to have concerns over, as well as what Biden is doing with the economy, and the biggest aspect of that is because of higher inflation. So yes, there's been wage growth, but it's eclipsed what's going on because of higher inflation. But again, we are still early days. It is still the summer of 2023, and we have till November of 2024. So the economic impact on voters could change, and a lot of voters do vote with their pocketbooks. So we really need to look at what does the economy say next summer and next fall, and I think that will start to dictate where people are leaning.
It also raises questions about the Fed's independence. Ron DeSantis talking about replacing Fed Chair Jay Powell. Not sure whether he thinks that he's not raising rates enough or he's raised them too far. How is that going to factor in terms of whether politicians want to fight inflation or want to support job growth and want to support momentum?
Well, what Ron DeSantis was talking about yesterday is that he doesn't like to see a politicized Fed. What's interesting is because Jay Powell was, of course, appointed by the Trump administration, a Republican, and then kept in the job by a Democrat, currently Joe Biden. But he was talking about he wants to see a Fed that has a strong approach when it comes to maintaining a stable, strong U.S. dollar. So he likely would want to maybe get rid of Jerome Powell. Didn't say it so directly, but the nod was there. These kind of questions are going to become incredibly more important towards the debate stage as well. And these are the kind of issues that, again, the donor class wants to hear about. And at the moment, a lot of the big money is waiting on the sidelines. And I think that's why you're starting to see individuals really start to talk about that. Former Governor Chris Christie talked about that with us here. He thinks he didn't like some of the things Jay Powell did, but is starting to turn it around, would reconsider him. These are the type of questions and the answers that donors want to hear from.
August 23rd, the big debate over in Milwaukee, about a month away. Anne-Marie, thank you. About 3 or 4 weeks away, actually, now. And that debate falls right slap bang in between Jackson Hole and the Fed get-together, the annual symposium, as it's called, 24th to the 26th of August. So it would be quite entertaining if you had Republican candidates for the presidency all complaining about the Federal Reserve on a stage and then right bang in the middle of that symposium over in Wyoming.
They're going to come out and give you some sense of what they're not going to talk about, which is pretty much anything. I mean, basically, that's what they're going to say is, look around. Things look pretty good.
It's so much easier on the outside to bash the economy and the Federal Reserve when you're not in power. And then you get in power and you need looser, easier policy to juice the economy. And then what are you calling for? It's so much easier when you're outside calling for tighter budget deficits, and then you get into power and what you want to do, you have the urge to spend. Whether you can keep those convictions from being on the outside to when you acquire power, that's the real test. And from what I've seen time after time, people have failed that test.
I would agree with that. And that's the one reason why people want an independent Federal Reserve, want an independent Bank of England, want an independent ECB, because if you are influenced by those conflicting real-time indicators and desires for growth or employment or other things, then you're not going to end up with a stable currency, and you'll end up with a situation that looks more like Erdogan's Turkey.
The criticism of Powell, though, is a valid one when it comes to coming out of the pandemic. They want inequality to be addressed by fiscal policy, not by monetary policy. And there were some not so subtle hints that the chairman of the Federal Reserve was interested in doing some of that.
There were also issues of his re-election and not making a decision soon enough.
And also juicing inequality himself by the policies that we've seen. From New York, this is Bloomberg. Equities on the S&P 500, slightly softer. We're down 0.25%. On the Nasdaq, we're down 0.4%. To get you set up for the week ahead on Thursday, earnings from Apple, earnings from Amazon. We're down on the Russell by 0.2%. The Russell is where the outperformance has been on the month last month. Through July, the Russell up 6%. The banks on the S&P 500, rip-roaring rally, up 10% on the S&P 500 Banks Index. Quite phenomenal stuff in the equity market as we start to think about maybe a shift in performance away from the dominance of big cap tech to the laggards, maybe. The financials, can that continue? Elise Ossenbar of JP Morgan Wealth Management with us about 30 minutes ago, suggesting it can. In the bond market, 2-year, 10-year, 30-year. Let's slice up the yield curve. It looks like this, unchanged on a 2-year right now, 487.67 on a 10-year yield, up a couple of basis points to 398. Lots of economic data a little bit later. Look out for the ISM manufacturing read, JOLTS, job openings, looking for that to pull back to something like 9.6 million, Lisa. Is that right?
That's the belief. I do want to say that Andrew Hollenhorst of Citi just published on the manufacturing ISM and saying that it has stabilized and could move back into expansion in coming months. He just publishing this moments ago. So this question around whether you see strength and actually the convergence of services and manufacturing, with manufacturing coming up to services, sort of defying recession expectations.
Where would that leave this bond market?
Exactly.
Oh, that could shake things up.
In a significant way, especially at a time when people have kind of shrugged off the risk, the tail risk of a Fed really raising rates further and then really building in the cuts that they're expecting next year.
Unbelievable. Let's finish on foreign exchange. The euro looks a little something like this against the dollar. Break of 110, 109.77. We're negative here by 0.2%. ECB officials in the last week not committing to anything from September. I think Lagarde over the weekend was speaking to Le Figaro, a newspaper, a media outlook over in Europe, and gave us absolutely nothing, Lisa. We might hike, we might pause, but if we pause, it might not be a pause for as long as you think a pause might be. Does that help?
That was fantastic. You should do that again. Basically, no, it did not help.
Nothing. Under surveillance this morning, the latest manufacturing data out of China disappointing. The Caixin PMI falling to a 6-month low and below the 50 level that marks the difference between expansion and contraction. This not the only read of contraction for Chinese manufacturing. We had the official PMI come out earlier this week. Also, Lisa, showing a decline, and we've seen this pretty much across the board out of that economy.
And it's really going to only increase in terms of pressure on the economy if commodity prices remain high at a time when people are wondering, where is the node of growth going to come from? It was supposed to come from middle-class spending. It was supposed to come from the reopening. Now people are wondering, can it continue to come from the construction sector at a time when the government doesn't seem to want to support that? It's already overbuilt. They've already kind of tapped that well. What do they go to then?
Balance sheet recession. I'm going to hear more and more about it. I know we are. Are they pushing on a string? Are they pushing on a string? Are we just starting to see that deleveraging kick in? And it doesn't matter what you do around certain policies, that people don't want an extra apartment. They don't want another car.
There is a feeling, and I've seen the speculation, could China be headed toward a lost decade, akin to what we saw in Japan? Is the deflation and the aging of the population, combined with the unemployment among the youth population and the way that they've stimulated their economy over the past couple of years, really lead to some very slow growth for a long period of time?
The problem with this conversation, of course, is that this could have just been a conversation we clipped from 10 years ago that we're replaying right now. It's not, by the way, it's live, but it could have been, right?
You probably could say that about a number of our conversations.
Exactly the same things.
That's sad.
Plenty of earnings this morning. Caterpillar, don't be sad, posting a second quarter profit that beat Wall Street estimates as demand for its heavy machinery held up pretty well against expectations, sort of defying the doom and gloom once again. Seen as a bellwether for the economy, as you all know, given the critical role its equipment plays in construction, mining, and energy, and it's holding up okay. It's up in a pre-market as well, Lisa. A slight warning, I would say, about the third quarter not being as good as the second quarter, but still defying expectations.
I want to just dovetail this into our conversation about commodities. If Caterpillar is seeing incredible demand for building, for mining, for energy, what does that mean about the prices of all of these things, given that demand for them has been so much higher? Again, this goes to the question of how do we see ongoing disinflation if the good side of the economy is hanging in there much better than expected? That's why I find Caterpillar as a bellwether fascinating. People are looking at the good and not necessarily some of the more concerning elements that speak to inflation.
Do you talk lots about home prices? In the UK, it's an obsession.
Well, yes.
You spend a lot of time talking about home prices in the UK. It's just a thing.
Truth be told, I don't, just because I did purchase and then I watch the prices go down so much that I try to avoid it at all times. But at the same time, yes, a lot of people do talk about it, but not quite to the same degree as in the UK.
Spend loads of time on Zillow?
I don't.
I'm a Zillow addict.
I know you are.
Rightmove as well over in the UK. I love those websites.
What do you look for?
Anything. Just dream houses, houses that I might live in.
Farms.
Houses that I can't afford. Just everything. Do you
Little
not do that?
castles on top of
Very
rocks.
aspirational. Yeah, you know.
No, I look for vacation destinations.
Houses on the Amalfi Coast with a lemon
groves.
Oh,
A
just
cow.
stuff I'm never going to have, but that's
to
fine.
make, gelato.
Yeah, precisely.
I know your
stuff.
vibe.
UK home prices falling at the fastest rate since 2009. The Nationwide Building Society said prices fell 3.8%, slightly less than the 4% decline that some people were looking for. The drop coming, of course, as the Bank of England sets to hike interest rates once again. They're already at 5%. They may well be going higher this Thursday. The 2-year fixed residential mortgage rate over in the UK right now is through 6%. What matters here is that the effective rate, so that's the average rate being paid on the total outstanding stock of mortgages in the United Kingdom right now, is creeping higher, but not as quick as you might expect. We've gone from 2 to close to 3 from the starting of the hiking cycle coming into the summer.
Since I'm sitting here, if I were channeling Tom Keene, and you might get upset that I'm going to say this.
Sure.
How much of this is Brexit? How much of this is a lack of immigration? How much of this is the idea of a financial center moving, maybe even on the margins, to other regions in Europe that's affecting this as much as rates in a very idiosyncratic way?
Home prices or
Yes.
the inflation backdrop?
Home prices.
Oh, home prices I just think is the natural feed through of the structure of the mortgage market in the UK. And you see that in the effective mortgage rate. The fact we're talking about a 2-year fix in the UK and we're talking about 30-year mortgages in the United States at like 2.5%, 3%. I'm not sure that's a Brexit factor. That's just the structure of the mortgage market where you'd expect that bleed through from higher rates of the Bank of England into the housing market maybe a lot faster.
And people are basically expecting that to happen later, even if it's not happening now, because it's more imminent because of the short-term structure of those mortgages. And that's sort of the reason why.
Yeah, you'd expect to see more of it. There's going to be some pain there if this continues. You hold rates at 5%. I was going through some of the remortgaging numbers, got the number in front of me. 1.4 million are due to remortgage this year, so representing about a fifth of all households with a mortgage. So 5% of the total number of households. So bear that in mind. Those numbers from UBS more recently. But clearly, as the years progress and more people have got to shift away from what you could get in the pandemic for interest rates, it's going to hurt. And mortgage rates are going to go up.
This is the reason why I don't look at home prices, because I fear that if we were actually reflective of where rates really were, the prices would go down so much I don't even look. That's the truth.
Let's get to Guy Labat, Chief Fixed Income Strategist over at Jenny Montgomery Scott. Guy, wonderful to catch up with you, sir. I actually want to start with credit because I know you're focused there. There's this line in the sand for you, and I'd love for you to talk to us about it. It's 400 basis points, high yield spreads, and we've dropped below that level, as you say, quite comfortably over the last month. Guy, what does that tell you?
So good morning, John. Good morning, Lisa. Starting in early 2022, about March to early April or so, high yield spreads widened considerably along with both the initial big increase in interest rates and the sell-off in equities that started around that period. And since really mid to late April, high yield credit spreads in the U.S. have been generally holding above 400 basis points. And historically, 400 basis points is what I describe as kind of the Maginot line between healthy and unhealthy high yield markets. Typically, when you're north of 400, you don't see a lot of new issuance. New issuance that does come struggle. It also tends to pass through some effects into other markets like equities. And high yield spreads stayed above the 400 basis point mark really from that April period, give or take, with a couple of quick dips below, until roughly about a month ago or so. And for the first time since the initial sell-off back in 2022, high yield spreads have now held beneath 400 basis points, which I think is particularly constructive for a lot of other markets as well, because lower volatility on that higher risk element to the credit spectrum speaks to greater stability in all sorts of things, such as equities. In some degree, it confirms the recent rally we've seen in the equity markets as well.
Guy, we were just talking about UK housing prices and how much more sensitive they are to rates adjusting to the higher level that we've seen them in recently. And we talk about how sticky the low rates are in the U.S. when it comes to the housing market. It's also true when it comes to corporate financing rates. And we've seen that pretty consistently. And Lori Calvasina did some great work on that from RBC, showing just how locked in some of these low rates are for both high risk and low risk companies alike. How much do you think that is buffering the view of defaults in a way that changes if rates stay high for another year or 2 years?
So that's a really interesting point, Lisa. So in late 2020 into 2021, there was a huge refinancing wave, not just in the mortgage markets here in the United States, but also in the high yield credit markets as well. We saw issuers selling, 5, 7, even 10-year high yield deals and using the proceeds to buy out short-term debt maturities in order to reduce their overall coupon payments. So if you look at the U.S. high yield index, there's almost no maturities in the U.S. high yield index until about mid-2025, give or take. So as a high yield company, now there are exceptions, of course, but in general, it's pretty hard to default on your debt if you don't have a debt maturity coming due. So to some degree, that pushes out the risk of defaults into 2025, which, given the current range of economic outlooks from here, the world could look very, very different by 2025, either lower or higher interest rate, and probably on the road to a recovery after what I expect would be a mild recession. So the refinancing boom, the next round, really doesn't have to take place until after the sort of gap where we anticipate interest rates will be somewhat lower.
So just 30 seconds here. Do you think that people are too bulled up, or do you think that people are appropriately pricing in risk based on that assessment?
Well, I think we're reasonably appropriately pricing risk for the fundamental outlook. High yield leverage is low compared to historical aggregates. There has not been an excess of leverage that built up over this cycle for all sorts of reasons. Refinancing risk is low. So fundamentally, the risk is low. That said, if we do get another economic risk emerging sort of in late this year, early next year, I think high yield spreads are likely to drift wider in the face of that nonetheless.
Hey, Guy, thank you for the update on credit. Guy Labat there of Jenny Montgomery Scott. High yield spreads tight. An equity market looking out for all-time highs, just not expected to be here 6 months ago, were we?
I think that's the understatement of the year. Literally, people expected this to be a very bad year for risk assets, and it's been anything but.
Anything but. This morning a bit softer. No drama, though. We're down about 1/3% on the S&P 500. Looking out for earnings from the likes of Amazon and Apple coming up on Thursday, and looking out for data a little bit later this morning as well. Job openings. JOLTS, as they call it, and ISM manufacturing as well. If you are just tuning in, welcome to the programme. The equity market slightly negative. We're down here by 0.31%. In the bond market, yields a little bit higher by a couple of basis points, 398.29. Looking ahead to that economic data a little bit later, Dana Peterson at 8:30 Eastern time of the Conference Board. It's been a while. We haven't caught up with Dana for a while, Lisa, so I'm looking forward to hearing that conversation with you both.
I want to understand how long people can actually keep traveling around the world on things like cruise lines. I was looking at Norwegian Cruise, which came out, and they boosted their full year adjusted earnings per share estimate, which is, I guess, a good thing. And you see that the cruise days, just to give you a sense, passenger cruise days, this is how many people love cruises, 5.78 million. That's up 93% year over year. Of course, it's a pretty low comp given where we were with the pandemic, basically in line with the expectations. But those shares significantly lower, even though they did raise their expectations. Again, it has been a theme that we've seen, John, that when people report, the upside surprises are rewarded less and the downside surprises are punished more. So even with some of the enthusiasm we've seen in the index, that has been a theme.
One of the top 10 performing stocks on the equity market for the whole of this year. It's up 80% year to date.
Details.
Yeah. Carnival's up 133%. Royal Caribbean is up 121%. I mean, the gains of these cruise lines this year have been ridiculous. Absolutely ridiculous.
Especially after being left for dead and incurring a lot of debt. Remember how much debt they really took on in order to maintain their ships during the pandemic, which were just basically parked, waiting for people to come.
I remember some of those high yield issues in the pandemic.
And people were saying, how are they going to pay this back?
I was saying then, who's going to get on a boat and go on a vacation and be stuck with people? And I'm saying it today, even after the pandemic, who wants to get on a boat? And apparently lots of people do. So what do I know?
Are you going to take it back? 47?
No, stock is down 8% in the pre-market.
70? Come
this
on.
is not an equity call, all right? It's just a lifestyle call. This is Bloomberg.
20% talk about this environment, it makes me think of the sort of old Looney Tunes cartoon where the character is sort of running above the air, and you're not quite sure if they'll sort of crash or if some sort of parachutes will appear and help them float. And the key word is uncertainty. That's what we hear. We hear with our clients. They're not sure how markets will react.
A lot of head scratching this year, that's for sure. That was the Man Group CFO catching up with our team over in London a little bit earlier this morning. Uncertainty. There's always uncertainty, Bramo. It's never the absence of uncertainty about the future. It's just that a lot of people have called the future wrong so far this year.
I think people are saying uncertainty of trusting yourself, about your presumptions, about what's expected to happen, because everyone's assumptions have been completely wrong, to your point. And that, I think, is upending some of the confidence in the C-suite.
He described the Looney Tunes cartoon. You've got the character, sort of treading an air before it drops off. What's that, Wally Coyote?
Yeah.
I think so, yeah. Anyway.
It's like running and it doesn't
that
start
was true
to
of the
for a while.
pandemic as well. You had all that stimulus just holding the economy, suspending it in air when there was basically no economic activity in many places and many sectors. And I feel like we've been talking about that now for 3 years.
Which is the reason why people are dropping it. And when you do bring it up and you are bearish, you get a lot of hate mail. I'm just saying, because people are saying, you've been wrong, you've done this for a long time, and it's not necessarily coming to pass. And maybe that's true. Maybe this time is different, and this economy has more strength than a lot of people have really previously believed.
I don't have the full context of that conversation, so this is not aimed at that individual. But I think just saying that line would mischaracterize where we actually have been. What we did was underappreciate the lag of that stimulus even after reopening and beyond the pandemic, the amount of savings that was left in the economy, the amount of refinancing that was done throughout the pandemic, both on the corporate side and for households as well, it's just meant that basically this economy has become less exposed to higher interest rates from the Federal Reserve. So to make out we're sort of suspended in thin air, I think it doesn't acknowledge the actual fundamentals of the economy so far this year. The consensus just got it wrong. This economy has stood up to these interest rates much, much better than most people thought it would. We were too preoccupied with the stock of debt and not the profile of the debt, the character of it, the maturity of that debt. And that's where we are right now.
And the intelligence of the homeowner and the intelligence of the C-suite in saying, if we can issue 30-year debt, we will. If we can borrow for that long and lock in these costs, we will. And during the pandemic, guess what all of those companies and individuals did? They refinanced their debt, got those low rates, and got them in for as long as possible to eliminate this exact risk.
It doesn't mean that you should extrapolate out current conditions over the next several years. It's just an observation about where we are and where people thought we would be, Lisa.
And it mitigates the potential risk, the potential downside risk to economic growth.
Let's talk about this stealth rally in the oil market. What did you say last month was best month since when?
It's been the best month since January of 2022.
Wow, quite a run for crude. Brent crude right now at 85. Regina Mayer joins us, Global Head of Clients and Markets over at KPMG. Regina, let's start there and talk about this run. And great to catch up with you and welcome to the programme as always. What's underpinning that rally through July and can it continue through August?
Well, demand continues to outpace supply, and OPEC Plus, with its strategic cuts and even the Saudis' voluntary 1 million barrel per day cut that they've indicated they will extend through September, has created buoyancy in the crude markets, like Brent above 85, WTI once again above 80, and that demand is outpacing supply. There are some analysts that are saying when we're able to go back and analyze the actual demand figures, that July, given it was one of the hottest months on record or the hottest month on record, and we still rely on a lot of fossil fuels to drive cooling, that July of 2023 will be the highest demand for hydrocarbons ever, outpacing August of 2019.
Wow. Regina, where's that incremental demand coming from? Has it been Europe, where we've had this massive heat wave, the United States? Has it come from China? Where's it coming from?
Well, China has just not given us the demand uptick that we keep expecting. I think I've been on your program multiple times, and it's always Chinese demand will pick up in the next few months. Chinese demand will pick up in the next few months. The thing that's really created the added demand is industrial activity is picking up in the Western market. So the supply chain challenges, the debottlenecking that's occurred, and the travel. You all were talking about cruise passengers. There's still tremendous travel consumption, tremendous bullishness in the consuming population. We continue to consume, we continue to travel, companies continue to produce, and that's driving record demand on top of it's a really, really, really hot summer, and it takes a lot to drive the cooling that we need.
And it also is interrupting some of the processing. There was a piece out this morning talking about how the very hot weather has reduced some of the refining capabilities of certain companies. You also are seeing some of the shipping costs for even natural gas rising substantially over in Europe. How much is this fueling a call from you that oil prices are going to go substantially higher, even natural gas over in Europe?
I'm not as bit bullish that the prices will continue to go higher, Lisa. I do think that supply continues to meet this record demand that we're facing, and we're going to get a peak, right? Summer travel is in the US is starting to tail off. I know in Europe it's kicking off for August, but there's an end to that. And so I don't think we'll see the big spikes that we've seen in the past. I think that demand continues to or supply continues to roughly meet demand. The story in the gasoline price spikes that we've seen in the U.S., it's just inventory. It's inventory. And motor gasoline and refined products don't move around the world as well as crude does. So they are very geographically specific. And in the U.S., motor gasoline stocks, inventory stocks, are down to its lowest level since 2015. I think that is a remarkable statistic.
How do they rebuild that, especially at a time when there is concern about the Strategic Petroleum Reserve of the U.S. and there's a question about rebuilding that, and there is a lack of refineries in the United States?
Yeah, so the refining industry has contracted significantly, but it's also incredibly more efficient than it ever was. Refineries are still running pretty flat out. The statistics I was looking at showed roughly 94% utilization throughout the month of July, which is really about as high as they can get it, maybe 95, 96, but just a little bit, a few basis points above what they're currently at. But we will see summer driving season come back down. The demand for motor gasoline will rationalize, and the refineries will be able to catch up. We will see a short-term spike in gasoline prices, but I do see consumers seem to be less reactive to the price at the pump. Our survey KPMG recently did, 49% of consumers say they're moderately or concerned about the higher price of gasoline. That's down from 70% last year at this time. So I think there's less price sensitivity in terms of gasoline consumption as well.
Regina, how do you differentiate between less price sensitivity and prices just not being as high as they were last year?
Fair point, John. But I do think because of this consumption boom and that there's inflationary pressure across a lot of activities, we've seen price spikes in different commodities like eggs over time, and the prices for experiences and restaurant activity, travel costs, and we still see consumption moving. So I do think there is perhaps less price sensitivity overall with the consumer. Maybe we're becoming more immune to some of the inflationary impacts. That'll only last for a certain period of time. But I do think we're benefiting from that lack of price sensitivity.
Don't tell the airlines. Regina, thank you. Regina Mayer of KPMG. They don't need encouraging, do they?
No.
Not at all. I'm complaining on behalf of me and everyone else, by the way.
Thank you. You mean in terms of how much they've jacked up prices and people keep paying it? It's ridiculous.
The customer experience all round is just sort of like falling off a cliff.
So what is your view on the lounges?
You know my view on the lounges.
You don't go?
I don't go to the lounges.
Ever?
Rarely. You might see me in one now and again, but rarely.
Because they're too crowded?
Often at certain airports, you're better off just going to get a meal somewhere else.
We don't want to wait in line with people?
I'll give you an example. Tiered. Delta at JFK. Didn't they open a new lounge there? Because Delta in the last 12 months, the lounges there have just been, there's lines going around the corner.
Especially right before.
Seems to me you just sort of get a credit card. This is not a credit card. I just wanted to hold something up. It's my name tag to get into the building. Seems to me that you get a credit card and you spend a bit of money for a month and you get top tier at these airlines and you can get in any lounge you like.
Well, you can get into the lounge.
Flying.
Well, but this is not without flying. You need to show a ticket. It's not quite that much.
No, you can have a ticket, but sure. But usually you'd acquire points through flying.
Right.
And now it's just spending.
Correct. However, people are tiered. I always think of airlines as being sort of the key, class kind of conscious moment where people are basically tiered for what kind of medallion you are and what kind of
no problem with the class system up in the air. I've got no problem with it at all. Just let's establish the class system through effort and through miles flown and money spent on the airline.
Well, they make a lot of money.
Not just sort of like spending. I go to the restaurant and get double points with my AA Advantage card.
Well, you can buy it at the airport and then get extra points.
Anyway, you know my thoughts on this, and I think a lot of people are familiar with them now as well. So I look forward to catching up with Ed Bastian if he ever wants to come.
I look forward to getting out of here.
Talk about it. Michael O'Rourke of Jones Trading joining us shortly.
We're going into a different, higher nominal GDP world.
When the Fed pivots, that's when the new cycle emerges.
Even though the labor market is still quite strong and the balance sheets are quite strong, there's still risks out there.
The two things that we're watching most closely on the economic front are productivity and oil.
I think I can state with a high level of confidence through the end of this year, we're going to remain recession-free.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The smell of capitulation. There's a lot of catch-up trades out there this morning. Live from New York City. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market is down by a third of 1%. Yields on the long end just a little bit higher. The dollar stronger against the euro, more so against the yen and against sterling, going into a Bank of England rate decision later on this week. This note just popped into my inbox. It comes from Patrick Shallis over at Gordon Haskett. Shout out to Patrick. It says catch-up calls, Nirvana calls, and then just says, exclamation mark across the top of that email. Thank you for that. So we've got an upgrade from Citi, new price target there. They look for 5,000 by the middle of next year. And let's call out someone who actually got it right, though. John Stolfus of Oppenheimer, who looked for 4,400. That was his year-end price target, year-end last year. And he was looking for 4,400. So this upgrade, I think that's notable. He looked for 4,400. It's come early, and he says, look, we can have some more in 2023.
I remember him coming on the show and talking about his price target. And I looked at him and I said, aren't you worried about the rate hiking cycle? Aren't you worried about the idea that we might get recession? Aren't you worried about
being wrong again after being wrong last year?
Exactly. And he was like, no, I'm not. Like, sure, you can always be wrong, but you have to look at the dynamism in the economy. And I thought to myself, no way. And you know what?
Hey, here we are.
He was absolutely right.
NASDAQ with a rip-roaring rally. A little bit later on this morning, you'll get some economic data, job openings in America. It's called JOLTS. JOLTS, which we all just sort of talk about now. Job openings, we're expecting them to come down. Then ISM manufacturing later on this morning. Look out for that too. It's important. Manufacturing's been softer recently, starting to stabilise. Can that converge to services? A conversation Lisa started again a little bit earlier this morning. Earlier on today, more data out of China. Another read of manufacturing, disappointing, contractionary. The PBOC out with some headlines moments ago. We spent the last couple of minutes trying to translate some of this into English for you. So they're going to guide banks to adjust existing mortgage rates lower, just reiterating some support to keep the housing market stable. But ultimately, Lisa, this is something they want to see improve, an area of the economy they want to do something about.
The lack of clarity here comes partly because of a translation issue, but also partly because there aren't concrete steps being taken. And this seems to be, as you've said before, this posture of easing that doesn't have a lot of details. How much does this sort of add to that, this idea that they're trying to somehow backstop the housing market in a way that doesn't include reinflating it? How do they plan to thread that needle at a time where they don't have that much appetite to sort of reignite some of the leverage that has really been built into the housing market?
It's an easing posture. I don't think anyone right now would describe it as aggressive monetary policy or fiscal stimulus when they say things like, we'll continue to implement prudent monetary policy. We want to support the healthy development of the property market. It's quite incremental stuff, Lisa. The hope is you get more of it and it adds up in the coming weeks and months.
Just simply shrinking the potential down payment that people have to make and cutting rates isn't going to be enough at a time when a lot of people aren't working and have questions about the state of the economy. So to your point, to the extent that this can actually support anything remains to be seen. In the equity markets, though, people seem pretty excited. So there you go.
Not this morning, at least. In China, they have been. Last week, best week of the year for Chinese equities. The hope around EM more broadly, we touched on it a little bit just yesterday. The rate cuts are arriving. Chile, perhaps Brazil later this week. You get an easing stance out of China, and EM equities start to look a little better. Isn't that the call?
That has been the call. And I wonder if we start to see on the margins capitulation, because you've seen a pretty incredible rally in emerging market debt and FX in particular, especially because I was looking at South Korea and some Thailand, some of the other Southeast Asian nations that are affected by the contraction that you're seeing in China. And you're seeing some of the export numbers to China go down. So at what point does this start to have a bit of a cycle in some of the areas that have benefited from other aspects of the global economy?
Let's whip through the price action just to get you all up to speed. Just briefly, we're negative here by 0.3% on the S&P. Yields are a little bit higher. We talked about Treasury yields higher by 3 basis points or so, just south of 4%, 398.89 in the FX market. The dollar's shown some strength today across the board in G10 against the yen, against sterling, against the euro. A break of 110, 109.76. We're negative here by 0.2%. Joining us now in this equity market, Michael O'Rourke, Chief Market Strategist at Jones Trading. Michael, when you start to get a little bit of capitulation out there, you start to see these price targets track the rally we've seen so far year to date. Just engage me on the conversation around sentiment. Michael, do you get nervous when you start to see that?
I'm not going to say I get nervous when I start to see it, but what you're definitely seeing here is people's, they're reacting to price. They're reacting to a market that's been extremely strong in the first 7 months of the year. And they're questioning that, their expectations coming into the year. My note last night was I titled it "Too Early to Declare Victory," because we still have 4% inflation. And although the Fed may be done tightening or is very close to being done tightening, the market's acting as if it's the actual rate hikes themselves that are the headwind. It's not the hikes. It's living with those higher interest rates, that higher real Fed funds rate that's going to tighten on the economy the longer that persists. So you can't celebrate the Fed being done, because now we have to live with the tightest environment we've had in 15 years or so.
Well, Michael, when does it start to bounce? And that's the trillion-dollar question. 6 months, a year, 2 years? Just how long and variable are these lags?
Well, you're right. It is the trillion-dollar question, and that's why I think it's funny. Everyone's saying the recession calls are wrong and such, but they were pretty widely held at the start of the year. And the Fed itself, its own forecasts for growth, et cetera, are much lower. The fact of the matter is they didn't tighten policy enough to slow inflation to the rate they wanted to. So because policy wasn't there to bring the appropriate slowing, we still have an economy that's been gangbusters all year. I mean, up until this last jobs report, we were averaging over 300,000 jobs per month. We only need to add about 80,000 to keep the unemployment rate from rising. So we still have an unemployment rate near 6-decade lows. So it's understandable. The economy's grown over 2% the first half of the year. We haven't slowed yet, but again, we still are going to slow, and it's going to have to happen to get inflation down. So I don't know why everyone's celebrating at this point in time.
But Michael, momentum. Why not jump on the FOMO trade if it's worked? I mean, this is really what people are saying to us. And at one hand, I want to laugh and be like, really? Is that really what you're saying? And on the other hand, they've been right. I mean, they basically are saying that there's too much energy to keep things going up to really fight against it.
They have been right, and you're correct about that. But for everyone who's been right, how many people in their forecast said that 7 stocks would drive 65% of the S&P 500 gain this year? So, yes, we have an up market, but it's not necessarily a healthy market. And again, no one was predicting that you'd have trillion-dollar companies rallying 50 to 200% in 7 months. So, yes, they've been right on one measure, but they got there the wrong way. So I think that should urge caution, because you can't rely on 7 names to carry the market indefinitely.
What would you have to see in terms of a broadening out of the rally, a healthier kind of move that would make you feel a little bit differently, that would make you actually lean in a little bit more to this rally?
I mean, we have seen some positive signs, so I don't want to be totally negative here. Like, we've seen the Russell come to life in the past couple of months, the Russell 2000. I think that's a good sign. Again, I think what we all want to see is value stocks start outperforming, because again, they're a big portion of this market, and every growth rally seems to wind up in this, the capital seems to wind up in those 7 names. So I think those are things you want to see. I've said it before here. I'm a big fan of the banks. I think their problems are behind them. And I think there's a massive opportunity here. But again, while it seems like they're through the worst of their troubles, they haven't performed, obviously up to par with some of those big momentum names. So I think there's many opportunities in this market because the narrow leadership made so many other groups so much cheaper. I think that's or less expensive. That's how people should be looking at this market. They should be looking for those opportunities than chasing 7 names.
What about bond yields? A lot of people are betting on the Fed cutting rates next year, even as you do see sustained profit recoveries just simply because of this immaculate disinflation. Do you think that that's the case, or do you think that yields could go higher even still, as you say, and really pressure things the longer that the Fed keeps rates at an elevated level?
Well, obviously, the Fed has said they want to keep rates, higher for longer, but they've also said they will cut rates as inflation goes down. So I believe there'll be a point in time, and it might be late next year, that they'll start reducing rates. But I think that real interest rates adjusted for inflation are going to be higher. I mean, we've had a negative real interest rate environment for the past 15 years, for the most part. And now what the Fed is theoretically saying they're going to do is we're going to go back to a positive real interest rate environment, which is where we are now, and maintain that going forward. So basically, the Fed's rate cuts should barely just keep up or not even keep up with the pace at which inflation decelerates over the next year. So we're still going to wind up with a tighter monetary policy environment.
Michael O'Rourke of Jones Trading. Michael, thank you on the latest in this market. And the Federal Reserve and this determination to keep some kind of positive real rate, Lisa, even as inflation comes down.
This is one of the most, to me, the biggest aspects of the tightening policy that people seem to discount, that the Fed's going to cut rates before they really even take effect. This question of, okay, well, if you hold it there for long enough, all of a sudden the refinancing actually matters because these companies that have locked in these rates will actually accept higher rates.
There's a maturity wall out there somewhere. It's just not right here all at once.
But Guy Labat is saying that really the maturity wall for example, high yield comes in 2025. So if we get to 2025 and haven't brought rates substantially lower, you could be looking at some more weakness, but 2025 is a lifetime and nobody really cares about it.
Well, even if they are lower, they're higher than what some of these companies paid on their debt to begin with.
But that's my point. So there's going to be the tightening that has very long lags through the economy, especially if there is strength, especially if we don't get a recession, which really raises a question, when do you start pricing that in? People now seem to be saying, la, 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 we don't care because that's really far out there. And that seems to be working.
We don't have to think about it right now. Are you doing that? Sort of head in the sand and...
Yeah, it's great. Yeah, happy summer.
Having a good time.
Yeah, that's me. That's how I always work.
What, sort of head in the sand, pretending it's not happening?
Operation, Bank of Japan?
BOJ has been Operation Ostrich for a while. It's just hoping it's not happening. The communication from the BOJ recently is slightly odd.
That's a good way of saying it.
Slightly odd.
Did you see Winthin yesterday? He actually got angry. He was just like, Ueda, come on.
Disappointed in Ueda.
Yeah.
But we had disappointments around. I remember Chairman Powell when he started, President Lagarde. Yeah. You make mistakes. Remember President Lagarde, we're not here to close spreads? Okay, sure. If you're just joining the programme, welcome to the programme. The S&P 500 negative 0.3%. Joining us in about 18 minutes' time, Dana Peterson of the Conference Board, catching up with us about 8:30 Eastern Time, going into lots of economic data a little bit later on in America. We have job openings and the ISM manufacturing read as well, Lisa. All of that later this morning.
I'm very curious to see ISM manufacturing in particular, especially given what Andrew Hollenhorst of Citigroup was saying earlier this morning, that he actually thinks we could see a stabilization and a re-expansion, a re-acceleration in manufacturing. So manufacturing not dragging services to meet it, but the other way around, actually coming up to join services as people start to really double down, particularly with some of the housing sectors and other areas that have really revived.
That's what Neil Dutt has been talking about for a while over at Renmark. Need to catch up with Neil soon. Up next on this programme, we'll catch up with Elaine Becker of TD Cowen on the airline industry, and we're going to talk a little bit about airport lounges and what's happening with that at JFK and beyond. Really important conversation. It's why we booked her. We got in touch with her about 10 minutes ago.
All I could say is, unpopular opinion, I like the lounges. It's just, they do get crowded.
I like them when they're empty.
I enjoy them.
I enjoy them when they're quiet.
When there's nobody else there.
When no one else is there.
Go to Alaska.
Go to Alaska. Is it quiet?
There was no lounge.
Oh, right, okay. So one of those airports.
It's actually a huge shipping airport. We can get into that later.
Okay.
It's actually a really
interesting story. We can do that in a commercial break.
That's good.
I can't wait. It's going to be a good one. All right, from New York, this is Bloomberg.
American consumer has been pretty resilient. Our industry is very resilient. We're seeing growth for the industry back in the mid-single digits, which that's really where it was pre-COVID and pre this kind of COVID super cycle. We are still seeing premiumization within the consumer. Prices, so what's driving the growth is really the super premium priced products.
Deborah Crew there, the Diageo CEO, the distiller. Brewery, what are we calling them? Drinks company, Lisa?
Yeah.
Distiller?
Spirits industry.
Whiskey? Scotch?
Did you see Heineken? They didn't do that well.
What did they do?
They had disappointing earnings, and we're seeing questions around beer consumption post-pandemic after.
People don't drink beer anymore?
They say that people drink it, just less. And then spirits are like, oh, but we're back in it.
Is that a demo thing? The younger
I don't know.
demographic
I actually was trying to do some research and then got lost in a whole host of
because they
articles.
tried to get the younger demo hooked on hard seltzer and stuff like that, right? I say hooked, but obviously they always say drink responsibly. So
you're going to do that too? Well, I think that part of it probably is craft beers too, because there's been a real shift toward craft and not necessarily. Maybe I'm just skewed by New York. I don't know. These are the questions that I've really not developed.
They're really important questions. Let's look at JetBlue just quickly. Keep it together. JetBlue right now is negative by 6% in the pre-market, slashed its full-year profit outlook. Listen to this. Adjusted full-year earnings will be 5 cents to 40 cents a share, compared to the carrier's earlier outlook for 70 cents to $1. This came from JetBlue, Lisa, earlier this morning. We talked about the numbers themselves. The numbers themselves this morning were pretty much in line, but the outlook pretty dreadful.
Interesting to me that this really highlights the international travel over the domestic. And this really goes to business versus families. I think of JetBlue as being a very family-centric kind of vacation airway because it really focuses on a lot of routes that tend to foster that type of travel. I wonder how much that really highlights the international trips that are really fueling all of the numbers that we're seeing out of the travel industry.
I've said for ages, I've always thought JetBlue needs a rebrand.
Why?
Because too many people think it's the same as Spirit. And I don't think they did themselves any favours by pursuing the acquisition they were pursuing. Yeah, it just, I think they do. They see it as a low-end budget carrier. I've flown tons with JetBlue.
Have you flown with Spirit?
Transatlantic, no. Transatlantic and across this country to California. They have a great offering on JetBlue. It's a fantastic airline. I wouldn't consider it a budget low-end airline in America, but you ask people who haven't flown it, I believe that's what they think it is.
Well, it has good rates to islands and warm places from cold places, and that's the reputation that I've known it as. But I think that you're right. It tries to distinguish itself as both a low-cost airline while also having a modicum of quality, and it's a hard needle to thread for a lot of people.
It's like we're premium Ryanair, but we're not Ryanair. And they're really not Ryanair.
So. And they're not Frontier.
No, exactly. That's what I'm getting at.
Frontier is like you pay for the air you breathe.
That's what I'm getting at. Yeah, you've got thoughts on that. No, you have. Helene Becker joins us now, Senior Research Analyst at TD Cowen. Helene, let's talk about these airlines and the distinction that Lisa draws between the performance of the domestic-focused airlines and international. What's happening in the two markets at the moment, Helene?
Well, Lisa hit it on the head. We are seeing very good demand on the North Atlantic, especially, and we're seeing less good demand in the U.S. domestic market. And what we have been thinking is that 2021 and 2022 were all about U.S. domestic because there really wasn't a lot of places to go internationally. And now that the international markets are open again, people are traveling again. And we think this summer is all about Europe and next summer will be all about Asia, especially because the U.S. passport is not going to get you as far as it gets you now. Beginning in 2024, you're going to need a visa to go to Europe. You're going to need a visa to go to the UK. You can do it online, but it's going to cost you extra. And so I think you'll see that shift away from European countries to Asian countries.
We've got a playbook with regards to that, Helene, when we introduced the ESTA visa for Europeans and others to come to the United States. Does it really hit travel in that way, given how easy it is to actually complete the thing? I remember many years ago, I used to have to do that when I came to New York. Will it actually move the dial on visitors to Europe?
Yeah, I think it'll be a combination of that, and I think fares have been really, really high this summer. It's turned a lot of people off if you didn't book really early, and then and I think as Asia reopens, it's kind of, you know, we did Europe, now let's go someplace new, and I think that's the trend you're going to see probably beginning after Labor Day this year. and then going into 2024 and 5, and it'll probably be 25 before we get whatever normal is going to be, that single-digit growth that's probably sustainable. The 10-20% growth we're seeing in the industry and we've seen in the last couple of years is just not sustainable for a whole variety of reasons.
I have to say, we've done Europe. Now let's do Asia. It makes it seem like we're all just living in this herd mentality of post-pandemic reality. Helene, I'm looking right now also at visas to go to Europe, and they range from, it looks like, €7 to €40, depending on where you're going, although I could be getting this somewhat wrong. Helene, how much is this driven by business versus personal travel? How long can individuals and families continue to pay prices that seem pretty sticky and unresponsive to demand pressure in any way?
I've been trying to figure that question out too, because it seems to me when I go on a plane and I make a right turn, all these families are making a left turn. And I'm trying to figure out, I paid a lot of money for my ticket. I booked it 2 months ago. Or 10 weeks ago, and how come you're going there and I'm not? and I think that there's going to be pushback. I mean, I do think that people will just say, okay, we bought all our stuff during the pandemic, and then we did all our traveling after the pandemic, and now we're just going to get back to kind of a normal lifestyle of working, because I think over time, as we get further and further away from the pandemic, companies are going to require people, even in a hybrid environment, to come to the office more often than they've been going. And that won't lend itself to traveling Thursday to Tuesday or Thursday to Monday. And then business travel will shift, right? You'll see that shift in mix. You're laughing at me.
Well, no, I'm not laughing at you. Just the image that you paint of everybody who's not working, going with their families, paying through the nose to do Europe.
I thought Helene was going to give us a commentary on newborn babies and business class and whether they should be allowed in there or not.
Well, she can if you want to. Well, I'm just sitting here wondering, how long can people keep not working and spending all their money? Have you seen any signs of pushback on the pricing, Helene, as of yet? Or is all of your anticipation of that simply an extrapolation of pure logic?
Yeah, I think it's a combination of both. We have seen pushback on pricing. You've seen domestic prices come down pretty much on a year-over-year basis from really levels that, again, were not sustainable. So you're still above 2019 levels, but we're below 2022 levels. So I think that's a positive. And then, when you think about shifting demand, airlines can shift demand by lowering ticket prices, and people will respond to that. And then the last thing I would point out is in terms of visiting friends and relatives, China was closed for years, right? 3-4 years. And it opened earlier this year. And you don't see a lot of business travel there, some business travel. You don't see a lot of leisure for sure. But what you do see is a lot of people who couldn't get home for a couple of years going home. So that's the trend. And then 6-8 months, a year later, you start to see tourists pick up. But for sure, we're seeing pushback on pricing. And every Tuesday, I get fare sale offerings from a lot of the airlines. Just sign up for the email alerts to monitor discounts. And the discounts are deeper than they were 6 months ago. So yes, we're seeing some pressure on price.
Helene, I've got 10 seconds, so just pick a name. Favorite airline right now? Which stock is it?
Yeah, we're still on United.
Okay.
Lower domestic and higher international.
Scott Kirby, getting it done over at United. Helene, thank you. Helene Becker of TD. Cam, we never got to Ed Bastian and Delta, but maybe another day.
Maybe we could talk about lounges. I'm sure everybody was just really excited to talk about. I think they're done.
They're living it.
Okay.
So many people listening to this are like,
it's
so done with the airlines.
It's a small violin, though. It's a small violin. I mean, I agree with you, but
sure.
You can just go and get
just the whole thing, the way they treat you when you go through security. I've got, the whole experience is just dreadful.
It is, but it's gotten a little better on the edges.
Oh, the flight attendants are great. I'm just talking about the sort of like the preamble before that.
Yeah, the preamble is pretty rough.
Sure.
About an hour before the U.S. Open. Welcome back. This is Bloomberg Surveillance. We're seeing just a touch of weakness in equity markets after the fifth straight monthly gain, which is the longest streak going back to 2021 on the S&P 500. You could see a bit of dollar strength, a bit of euro weakness, 109.56 on that cross of euro dollar. 10-year yields just a touch higher, about 5 basis points to just over 4%, 4.01%. Crude. I'm really watching crude, actually, because I'm curious how long we can keep this rally. A little softer today, just a touch, $81.28 on the NYMEX. But we have seen the biggest monthly gain going back to the beginning of last year at a time when people talk about this as being one of the significant underpinnings of this disinflationary trend that we've seen borne out throughout the global economy, really. Coming up in about 90 minutes' time, we are going to get a slew of data, ISM manufacturing, as well as the JOLTS, the job openings data. Michael McKee, Bloomberg International Economics and Policy Correspondent, joining us here in studio. Mike, what are you looking for that you think is really going to be telling? What matters more, the JOLTS or the ISM manufacturing numbers for the Federal Reserve?
Well, I think in a sort of short-term compressed context, you're going to want to look at JOLTS because that's what the Fed has been looking at to tell them about how tight the labor market is. And right now we're looking at a drop, according to the survey, of about 224,000 job openings. What'll really matter is the jobs to unemployed ratio, which is about 1.6 now. We'll see if that goes down. It's still higher than 1-to-1, which is what the Fed is going to be looking for. With ISM, we're still looking at contraction, but the question is going to be, does it improve a little bit, and what happens to prices paid and employment? We've seen this contraction, but it hasn't really hurt employment all that much in manufacturing. Does that start to happen? So those are things that are going to tell us kind of what's happening with the labor market, which is what the Fed is mostly focused on now.
For a couple of days now, we've been talking to strategist after strategist about how everything is awesome and the U.S. economy is doing phenomenally, and why not just keep on feeling enthusiastic. And then on the corners, a couple people say, well, take a look at credit contraction, which has been ongoing, perhaps not a massive fissure. But yesterday, the Senior Loan Officer Opinion Survey came out and confirmed what Fed Chair Jay Powell said. There is a significant amount of credit tightening going on at the banks. How significant is that in terms of historical precedent and what it says about recession?
It's hard to actually say because while the Fed has been doing surveys of bank lending since 1964, the real data doesn't start until the mid-1990s. They've rejiggered the survey a couple of times, and that puts us with only 3 recessions, and it doesn't really give you an indication of what leads or not. In the in the 2003 recession, banks tightened a little bit ahead of time, but then you go to the great financial crisis, and they didn't start tightening their standards until we were already in recession, and obviously low standards were a reason for the recession. So it's hard to say whether it's going to correlate directly to it, but we have seen essentially what the Fed's looking for, a tightening of standards that in theory should bring down demand. Nothing terrible, but it should bring down demand, which is what their goal is.
And maybe that could create the softness in the labor market that can then create this disinflation that isn't too harmful. Michael McKee, thank you so much for being with us. We will follow up, I'm sure, throughout the day and week with some key employment data to round out the week. Right now, we are expecting the JOLTS report in about 90 minutes' time. Dana Peterson of the Conference Board weighing in on this, saying, quote, the June JOLTS data will give us a clue as to whether companies are taking down job ads and workers have slowed the quitting trend. Both will be important signs that the labor market is cooling without massive layoffs. If workers believe that there are fewer options, then they are less likely to quit and more likely to moderate spending. Dana Peterson, chief economist at the Conference Board, joining us now. Dana, how much evidence are you seeing of this kind of trend of workers getting less of the upper hand when it comes to demanding wage increases and working from home?
We're not actually seeing much there. When we look at the hard data, we still see lots of people quitting. That's why the JOLTS data today will be so important. And the key thing is that businesses are still hoarding labor, and they're also still hiring. We hear that from our CEOs. And so if you're a worker and you know your boss is not going to let you go because they are afraid of losing quality talent, or they think that if there is a downturn that it's going to be short and shallow, then you know that you have some job security there and you're not going to moderate your spending, as I mentioned.
So we're not expecting necessarily to see a big softening in the labor market. Pretty much everyone is saying that. You might see some moderation, but not significantly. We have Citigroup coming out this morning and saying they actually expect a reacceleration in the ISM manufacturing data, which was one of the weaker spots in the economy. Is this a backdrop for inflation continuing to cool? Or do you challenge that? Do you think that because of the labor market strength, because of what we're seeing in the rest of the economy, it's difficult to say that?
I think it's difficult to say. I mean, certainly when you look at manufacturing, it has been in recession because consumers are no longer buying goods only because now they can get out there and buy services. And of course, we've been talking a lot about travel, and certainly that's what people are doing. So it's hard to imagine, at least in the short run, the manufacturing sector, turning back around anytime soon. But certainly we have to pay more attention to services. That's the bigger part of employment. And certainly that's still being bolstered by the fact that some industries still haven't recouped all the people that they lost during the pandemic in terms of layoffs. And again, companies are holding on to labor. And with that holding on, they're also increasing wages and benefits, which is quite costly. And that feeds directly through to inflation.
Dana, earlier this morning, John and I were talking about CVS and how they're engaging in another round of layoffs with their corporate offices, not necessarily in their frontline workers in stores. How much has this continued to be a white-collar recession in ways that really aren't really fully represented in the overall data? In other words, there have been pockets that have seen much more substantial layoffs and weakening than really is expressed at the headline level.
Well, I believe people think it's a white-collar recession because when you look at who's getting let go, it's people in tech and finance, and those tend to be white-collar jobs. But we have to remember, tech and finance did incredibly well during the pandemic. There was a lot of demand for both, and there was a lot of overhiring in both of those sectors. And so now we're seeing right-sizing in finance and technology. We are seeing some of the layoffs spread out to other areas. But the reason why you're not seeing blue-collar workers being let go is because most of the demand is for services that are in person, you have to show up to. And there's not a lot of supply of labor for those types of jobs. And so that's why you're still seeing a lot of churn there. And that's why it seems like it's a white-collar versus a blue-collar recession. But I think it's more about labor shortages versus not.
How much have we corrected the labor shortages to really create confidence that we've avoided some sort of wage spiral?
Well, that's why the JOLTS data are so important, and I like to look at it, even though some people have issues with it, because you can look at how many job openings there are versus how many people are actually being hired. And I look at that as vacancies. And you still have a tremendous amount of vacancies across almost every industry. Only some, like construction, can go in and out from month to month, but most every industry is still saying that we have a lot of job openings and we're just not finding those people. And indeed, when we ask CEOs what you think, many of them are still saying that they're concerned that they won't find qualified workers over the next year. That's from our 2Q survey. And we're hoping, we're definitely going to see updates to that in our 3Q survey coming out this week.
Dana Peterson of the Conference Board, thank you so much. And we'll be catching up with you soon as some of that data becomes a bit clearer. Meanwhile, talking about employment, Uber came out with their earnings earlier this morning. And they paid up for their drivers. They said that they did increase their spending in order to attract, I believe, 33% more drivers in order to cater to a record amount of ridership. Joining us now is Mandeep Singh, Senior Technology Analyst at Bloomberg Intelligence. Mandeep, this really highlights the incredible demand for drivers, for Ubers, even at a time when the prices are going up tremendously. How long can it last?
I think it just goes to show that Uber is a clear category leader now, especially when it comes to mobility. On the delivery side, look, they are growing 14% when inflation is high single digit. It's not great growth, and freight is declining business. So everything when it comes to Uber is driven by how well mobility does. And right now there is that summer seasonality, which I think is helping. But when you look past the summer seasonality, the growth is somewhat tapering off because some of it is driven by pricing. Some of it is driven by share gain from Lyft. We know Lyft is growing low single digits. So Uber's category leading position is what's driving this. But I worry about the total end market growth going forward.
There's also a question about consumer pushback on some of the pricing. We were talking about the employment and how a lot of the drivers are getting more when it comes to being lured into work for Uber. You also see prices going up just generally in order to pad their profits.
Yeah.
Is there pushback? Have we seen it?
Well, so I think the numbers suggest, given the supply growth, right now there isn't a lot of pushback. And look, it's as a platform, it offers you that flexibility that you can work part-time, you can, drive your income. But I still think when it comes to take rates for a platform like this, having 20% plus take rates and not being able to show leverage in your business is worrisome. I mean, Uber is at a run rate of $35 billion a year. So you have to ask yourself, at what rate will this business start generating some serious free cash flow? And right now, you don't see that. The share count is going up. The free cash flow, the adjusted number is, yes, healthy, but it's all driven by mobility. So in the end, you have to ask yourself, is the delivery business really complementary? Is the freight business really additive to the business? And the answer probably is no.
Does the weakness that we saw in the freight aspect point to some other slowdown, whether it's just in general with goods or whether it's a broader consumer discretion, at least pull back a bit in certain areas?
I mean, with Uber, they're the number 5th or 6th when it comes to the freight side of the business. At least on the mobility side, they're a category leader. And look, the volumes are low. We've seen that with the other transports data that we follow. But look, they're trying to position themselves as a digital company that is a marketplace. It's an asset-light business. It just doesn't reflect that. And the way the business is being run, the insurance costs, I mean, that's a wild card with this business. They will come up with a quarter where the insurance costs just balloon and the margin leverage goes down. So that's where the sustainability of free cash flow or, how this business grows over time, it comes into question because you can have these abrupt quarters where some cost item will spike.
Which is a reason why we end up with a situation where some people are wondering whether the mobility aspect will be purchased by a big auto manufacturer who will then end up running it as a perhaps autonomous driving fleet. If you're just joining the program right now, you do see the S&P lower by about 0.4%, 45.95.25. We're talking with Mandeep Singh of Bloomberg Intelligence ahead of Thursday as well. Amazon and Apple coming out with some pretty big earnings. And I'm just wondering, so far, we see these massive gains in technology companies. The earnings seem to confirm it. Do you expect that to continue, or do you think that, as with Uber, there are signs that this isn't quite sustainable over a longer period?
I mean, especially when you look at Apple, this is all discretionary. People upgrading their phones or not. And if they're raising ASPs, my sense is that would slow down the rate of upgrade. So clearly, you will see some signs of, at least whether the hardware demand is picking up or not. And with Amazon, the AWS business, if large language models is the craze, they should participate in that, and they've taken down their AWS growth rate, so that's something to watch out for.
Do you think that one of the big auto manufacturers is going to buy Uber?
Well, I think it's too early because Uber first has to divest its freight business for it to be, and really what they are going to do with the delivery business. So it's still too early for that. And we haven't seen any signs of autonomous driving being a real business. You want to see signs of that first.
Mandeep Singh, thank you so much for being with us ahead of a really big week of earnings. We did get Uber earnings, just to repeat, better than expected on the profitability side, surprise profit. However, in the freight particular aspect, a decline, which you're seeing pretty much across the board as packages and other shipping comes down. Right now, you are seeing a bit of softness in markets, just a touch lower on yields as well, as people anticipate a slew of data, including manufacturing across the world. We have seen that recession in manufacturing. Does it continue in the United States? Coming up, Jonathan Miller of Miller Samuel on housing. This is Bloomberg.
Pretty hard to default on your debt if you don't have a debt maturity coming due. So to some degree, that pushes out the risk of defaults into 2025, which, given the current range of economic outlooks from here, the world could look very, very different by 2025, either lower or higher interest rate, and probably on the road to a recovery after what I expect would be a mild recession.
The locked-in cost has been one of the key buffers to what we've seen that otherwise would have been a likely credit cycle, both when it comes to corporations and individuals in areas like housing. That was Guy Labat, Chief Fixed Income Strategist at Janney Montgomery Scott. We are looking at markets a bit softer. We have been talking all day about the UK housing market and how much prices have declined. We're talking 2009 levels at a time when the U.S. has been ebullient, amazingly resilient, defied all expectations, bizarre, however you want to categorize it. Joining us now to do a much better job than I could, Jonathan Miller, President and CEO of Miller Samuel, who has an overview of U.S. housing markets and global housing markets at a time where it has befuddled pretty much everyone. What's your take on the resilience in a U.S. market that should have been brought down by these higher rates, akin to what we've seen in the U.K.?
Right. It's the difference between variable and fixed rates. Most of the world relies on variable mortgage rates. And in the U.S., people are locked in. And actually, the reason why we don't have a lot of inventory, and inventory is the metric to focus on, or lack of listing inventory. And that's because people are wedded to their low rates because rates were probably kept too low for too long.
There is a study that I was looking at. U.S. homeowners are nearly twice as willing to sell if their mortgage rate is 5% or higher, but just 1 in 5 mortgaged homes meet that criteria. In other words, they have such low rates, they're not going to move.
Right. It's like 80%. Yeah, 80% are sort of just sitting and waiting. There's uncertainty. Everybody's expecting a recession. We've been forecasting a recession in 6 months for 2 years. People are just sitting. When consumers are uncertain, they sit, they wait. And as a result, and also too, people that may want to buy, they have to sell their house to do it, but they can't find a house. So they're stuck. Inventory is extremely low across most of the markets that we cover.
Could you give us a sense, a historical precedent of the last time the inventory was so low, basically the number of homes on the market that you could potentially buy?
There hasn't been. The inventory now, for example, in Florida is 60% below pre-pandemic levels. Many housing markets, you're looking at inventory 30, 40, 50% lower than it was in 2019 before the pandemic, when rates really dropped and demand surged and there was a frenzy. I'm not sure people realize how extensive the obliteration of listing inventory was during the pandemic with rates being so low.
Well, so here's the question. Right now we see home builders going nuts, building as much as they possibly can because there is no inventory and people need a place to live. If rates do come back down, if there is a glut of new housing supply, could you see prices go down dramatically when the door is actually open to true price discovery?
I think so. I mean, the way to think of inventory coming back into the market, if rates drop substantially, they're sort of in the sixes, high sixes and low sevens. If they're in the fives, maybe we start talking about more supply coming on. But we have unemployment at 3.5%. It seems like there's more rate cuts in store just on that item alone, which sort of goes in the opposite direction of rates falling.
We were talking earlier about the UK, and I do want to just wonder if there is any corollary to what would happen in the U.S. if there were variable rates. We saw prices fall at the fastest pace going back to 2009. In the United Kingdom, they do have variable rates. We talked about that earlier. Would that be what we would see in the U.S. if we weren't shielded by a 30-year mortgage rate?
Absolutely. That's, the idea here is that the psychology is people are, locked in and they're able to enjoy a lower rate while people new to the market can't. And there's a premium for that. And one of the premiums is to sit and wait. It's a luxury, rather, that to sit and wait. You don't have to, we have home equity at, some of the highest levels in history. There's no stress for people having to sell. Economy's pretty good. People just sit and wait. And so I think this whole process is going to take time, which as opposed to, a few years rather than a few quarters.
One thing that some people will say is that the housing market has bottomed and that you're seeing a recovery. Is that an accurate way of characterizing a market that's essentially stagnating?
So I think when you refer to that, the reference is really to pricing, because pricing has leveled off and is rising in some markets from pandemic highs, if you will. But sales activity, is still way off, and the rate of descent has slowed. It's somewhat stable, but sales activity is held back because of inventory, and inventory is held back because of high rates, and high rates are held back because of low unemployment. I mean, it's just this whole domino thing.
Talking about the domino effect, you speak to a lot of mortgage brokers, I'm sure, and people who work in real estate.
Yes.
What's the mood like?
Well, it's interesting. Over the last year, there's been this sentiment that, hey, rates are going to come down. And I keep asking the question, with unemployment, at or near record lows consistently, how can rates be cut? Maybe they'll drift lower if the Fed stabilizes for a while. I think it's reasonable to expect that, but not a sharp decline. The economy is still too strong on the unemployment side. So it really, the Fed is going to have to keep using their baseball bat to damage the economy.
Well, if the rate structure, if we stay at around 5.5%, or even if we go down to 5%, say, for a full year, what does that do to inventory? What does that do to the mortgage market?
So first of all, that would be great to get things going. Rates in the mid fives even, I think, would pull a lot more people into the market, which would not in a panic sort of flood of inventory, but it would normalize to a certain degree, and we see transactions pick up. Right now, because of the lack of inventory, we're seeing bidding wars start to approach 40-50% of local housing markets, meaning sales that close above the last asking price. We're seeing some big numbers in certain markets, and that's because of chronic lack of supply. So the demand is still there, even with higher rates. So New York Metro is a prime example, and Southern California another example, where we're seeing bidding wars at nearly half of the closed transactions in the last quarter.
Are you seeing any soft patches?
Not really. I mean, soft patch to me would be defining it by price. Pricing is stable in terms of activity, sales, that is. Certainly, almost every market is very slow, and it's because everybody's stuck. No supply, no sales.
Is the Sun Belt still as hot as it used to be? I mean, I shouldn't have said that, bad metaphor, but I'm saying, is it still as popular, I should say, as it used to be?
Or I'd say it's hotter than outside the Sun Belt, but to use that same phrase. But but not as robust as it was. But I think in a lot of the Sun Belt markets, inventory is even tighter than in, say, markets like the Northeast, where inventory, while it's in many markets 20% off of pre-pandemic, it's not 60% off.
Jonathan Miller, thank you so much. This is really one of the most fascinating times I could possibly imagine for the housing market. Of Miller Samuel, I look forward to reading your next report, which will highlight all of the latest trends. Coming up on Bloomberg Technology at 12:45 p.m., Dara Khosrowshahi, Uber CEO, following earnings that had a surprise profit, record number of riders, giving more to attract a greater number of drivers, but a bit of weakness on the freight side. Right now, what we're seeing in the markets is a bit of softness after the longest streak of monthly gains in the S&P 500 going back to 2021, defying all expectations, up almost 20% year to date on the S&P 500. We do have from Oppenheimer this projection of a 28% gain to 4,900. John John Stolfus over there by the end of this year. Others joining the fray as people say this can continue because what's going to stop it and why fight momentum? Euro a little softer versus the dollar, 109.57. Just a touch higher in the yield space, 4.03% on the 10-year yield, and crude just a touch softer, but watching that after the biggest monthly gain going back to January of 2022. This was Bloomberg Surveillance. Join us on radio and the Bloomberg Open coming up next with Jonathan Ferro.